John, what it is a difference between a transformational campaign versus small ball. The reason why I say that is because Vice President Harris is very much identified with the progressive wing of the party. That's one big reason why she was chosen with Biden in 2020, frankly. So what she needs is a governor from a swing state that appeals to much more centrist voters. Governor Shapiro, I think, is the transformational pick here, and Governor Walz. If Governor Walz is picked, what that will show you is she's trying to shore up her own party and her own base. And so that seems to me to be the small ball pick, analogous to Trump and J.D. Vance.
How much do you think, Terry, that the vice president is going to be moved by what is going on within the progressive wing of her party? Do you think she is feeling the pressure? We had yesterday Bernie Sanders and Pramila Jayapal run a call. Obviously, they're throwing their weight, even if they're not mentioning him, to Governor Walz.
Well, I think that people that aren't in the middle of the pick tend to think that what they need to do is to be as loud and noisy as possible, and that will affect the pick. At the same time, I think we're really about to find out if the vice president herself is a really good politician, because really good politicians say, what do I do to win? Weak politicians say, how do I shore up the base of my own support? So I think that's what you see in the Shapiro versus Walz pick there. And I frankly think that the Bernie Sanderses of the world here have much less influence than they think. But then they'll want to take it out on Harris in other ways if they end up with Shapiro.
When you look at the policy of these two men, can you give a sense of what each of them bring to potential independent moderate voters in swing states that are unsure about who they're going to vote for?
Well, Walz is much more a darling of the progressive side, and he's been touted by the progressive side of the party for the last couple of weeks. Shapiro has a demonstrated track record of winning in Pennsylvania, and Pennsylvania is not only a really purple state when it comes to national politics and even state politics, but it's a state that is widely thought to be the tipping point state in this particular election. That is the state that has the most impact and most ability to move the election in Vice President Harris's direction. So for that reason, I think what you're going to see here is a Harris that is interested in winning and doing whatever she needs to do in order to bring the biggest tent and the biggest appeal to centrists that Shapiro has already appealed to, or you're going to see a move to the progressive side.
But at the end of the day, and polling over the weekend showed this with CBS News, she's already tightened the race. Do you think it really matters who she picks as VP?
Yeah, I think it matters hugely in two ways. One is, I'll insert the transformational point that I just made here. I think it shows you that she's serious and she's in to win if she picks Shapiro, number one. Number two, there's an awful lot of talk about how little vice presidents add to the mix usually. That's so, but Shapiro can help in a crucial swing state and maybe others, and that's no small thing, number one. And number two, vice presidents can have huge negative impacts on a ticket and how a ticket is perceived. We'll all remember Sarah Palin, who very quickly became a figure of fun and an anchor weighing down the McCain campaign in 2008.
Terry, forgive me for being really blunt with this question, but I kind of feel like we're dancing around it with this whole idea that the progressives might not like Shapiro. Mm-hmm. Is there just plain and simple anti-Semitism in this party that makes Josh Shapiro an unlikely pick for vice president?
I think that's much less, and I welcome the direct question. I think there's not a lot of anti-Semitism in the Democratic Party. I think you see some in specific parts of the Democratic Party. There's a large community of Somalians in Minnesota, for example. The influence of Palestinian Americans in Michigan is well known. There are some progressives who want a much more balanced view within their balance between Israel and Palestine in their own party, and more, frankly, on some levels. But no, I don't think the rank and file. I don't think the rank and file. I don't think the vast majority of Democratic leaders are anti-Semitic at all. They're trying to balance their ticket, and frankly, that's why Shapiro. One reason I think Shapiro makes more sense in a transformational campaigns sort of way than Walz does, because he actually balances the ticket by being as pro-Israel as he is.
And could we just say, Terry, that like the math of Pennsylvania means that he needs to be the choice too?
Yeah, well, it's as I say, it's the tipping point state, and number one, so it's considered this time out the most important state for whoever wins the election. The other reason is that frankly, anywhere outside of Philadelphia, in Pennsylvania, pretty much, what you're going to have is you're going to have a very red Republican pro-Trump voting bloc. The math in Pennsylvania always is that you've got to bring as much turnout in blue Philadelphia and the Philadelphia greater suburbs as possible in order to balance out the rest of the state and win. And Shapiro, frankly, brings that. So, it's another reason I think I would look for him.
Terry, I've got to take it back to basics and just ask a very simple question. What does Kamala Harris stand for? You talked about her short time in the Senate. I think we can gauge something from that. We can talk about her very short primary run. We can perhaps gauge something from that. But since then, I've got absolutely no idea. We've had 2 weeks since witnessing one of the most historic things we've seen in an election in this country for quite a while, with the sitting president dropping out of the race. And we haven't heard the vice president really answer a single question, apart from a brief moment on the tarmac following the hostage exchange. Terry, when are we actually going to start to hear what her policy preferences are?
I think, firstly, I think you'll start to hear from them at the convention. Secondly, it's an advantage in a politician to be a shapeshifter in some sense, and she's certainly proven an ability to be that. I say that with no disrespect. It's just she's weaved through a lot of different policy positions in a relatively short time on the national stage, and she's also had to be a loyal soldier to Biden in the bargain. But she has shown, she has shown no compunction about jettisoning more extreme positions and adopting more centrist positions in order to win. And a perfect example of that, since we're talking about Pennsylvania, is fracking ban, which she was unapologetically for 4 years ago, and now is already jettisoned. I expect more jettisoning and repositioning to be happening.
Looking forward to it. Terry, thank you, sir. Terry Haynes there of Pangea Policy. Terry nailed it. Liberal, moderate, pragmatist, shapeshifter. Right now, she is everything that different parties of the party want her to be, because she can be. And maybe right now that's to her advantage. How much longer that can last, I don't know. Let's see what the platform actually looks like. But before we dig deeper into the polls, we don't know what that platform actually is until we get to Labor Day and beyond.
True. I love what Libby Cantrell said last week, which is basically stay at the beach, have a cocktail. You don't really need to pay attention if you're in this market and want to know how to position yourself until after Labor Day. That's when the polls will really start to matter. Maybe we'll get more insight into her policies. She's going on a huge blitz this week. Wisconsin, Nevada, Georgia, North Carolina, Michigan. But a lot of this is going to be to ramp up that support, to get more dollars flowing in. I love that Terry Haynes ended on fracking. She wanted to ban fracking, but maybe not such a good idea when you want to win an election and you have to win Pennsylvania.
Yeah, there's a speech in Philadelphia later, right?
Yep.
I imagine
with
that's
her VP pick.
Not going to be a position that we hear much about, I imagine.
People like their jobs in Pennsylvania.
Yeah. Equity futures on the S&P 500 right now, positive by about 0.75% on the S&P. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. U.S. Secretary of State Antony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. He says the U.S. and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Tehran has warned it will respond after blaming Israel for killing a top Hamas leader last month in the Iranian capital. Elon Musk's X formerly known as Twitter, is closing its San Francisco office. A source saying CEO Linda Yaccarino made the announcement in an email to employees. Workers will be relocated to an existing office in San Jose and an engineering office in Palo Alto. The move marks the end of X's history in the city where Twitter was founded almost 20 years ago. And Tropical Storm Debbie threatens days of rain and floods along the East Coast after slamming into Florida as a hurricane yesterday. The storm left more than 300,000 people without power in Florida and Georgia, according to poweroutage.us. The governors of both those states and South Carolina have all declared emergencies, and President Joe Biden has approved federal help. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the good news. Bonds doing what bonds are meant to do.
Yields at the short end will stay a little bit higher, if not go pricing a little bit higher from here. So, you know, those short-term interest rates, that short end, the yield curve for investors may look a little bit interesting. Bonds are buffering you against the sell-off in equities.
That conversation up next. Live from New York, you're watching Bloomberg TV.
Names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
After 8 days of rally and just a little bit of weakness in the bond market, yields are up by 5 basis points now on a 10-year. We're back to about 383.71. If you're looking for a bounce in the yen, or rather in dollar yen, to be much more precise, you've got one. It's a small one. Dollar yen 144.83. So that's a weaker Japanese yen by only 0.5%. And likewise in the equity market, not much of a bounce compared to the losses we saw on the screen yesterday. It's picking up though. We're up by 0.9% on the S&P 500. Under surveillance this morning, the good news. Bonds are doing what bonds are meant to do.
The market is now pricing a greater risk of recession, a greater risk of declining rates than we would expect, and that therefore yields at the short end will stay a little bit higher, if not go pricing a little bit higher from here. So, you know, those short-term interest rates, that short end, the yield curve for investors may look a little bit interesting. Bonds are buffering you against the sell-off in equities.
So here's the latest. Treasury yields bouncing back from yesterday's lows following better than expected services data. James Athey of Marlborough not buying into signs of resilience and saying this: we're late cycle, rising unemployment and ultimately recession will follow, and therefore a defensive portfolio makes the most sense. James joins us now for more. So James, let's pick out a couple of your trades. Long duration, long the Japanese yen. And let's take a little step back and think about where we've been and what's happened over the last few days. We have come a long way in a very short amount of time. James, are you sticking with those trades?
Yeah, hey, good morning, John. Yeah, absolutely. I mean, I agree that, you know, just on a short-term basis, the market does look overbought in duration terms and potentially overbought in yen terms too. Just the speed that we've seen these things move just mean technicals look a bit stretched, and so some consolidation is likely, and I think we're seeing that already. If I were a duration bear, I'd be looking at this bounce in yields and saying, wow, that is incredibly disappointing relative to the rally which preceded it. But looking further into the future, I still think that there's a mismatch between the value that's on offer in duration versus the likely destination for interest rates, and also that's without factoring in the potential for weakness in the equity market as both earnings multiples and earnings themselves have to correct to a more normal level.
Well, James, let's pick out a piece of that. Let's pick out the rates call first. What do you think the likely destination for rates actually is then? We're at 550 now. What are we coming down to? And why are we so mispriced with a 2-year already down to sub 4%?
Yeah, exactly. Well, I think a lot of people were working with the idea that the Fed would ease back to 3.5 as part of a soft landing narrative. I don't think that factors in recession at all. I think traditionally speaking, if we go back over a long period of time, the Fed likely cuts 500 basis points at least in terms of dealing with a recession. So if we do go into recession, and I don't really buy this idea of conveniently mild recession. That's not to say we have a crisis per se, but a normal recession. We'll see the Fed respond quite aggressively. And of course, we know also that the Fed is hypersensitive to financial conditions, and ultimately that means to the equity market. So if you combine those two, I think it is reasonable to see rates coming down even compared to where the market is pricing them currently.
The market did come around to the idea in some ways yesterday, James, that maybe it wasn't an all-out recession on the cards, just with that flip we had in bonds. But what do you make of the fact that equities did not flip? That equities still sold off, not huge, but still some 3% yesterday.
Yeah, exactly. I mean, I wasn't surprised by the bounce in ISM, which I think triggered the kind of intraday reversal. Very much previous month was weather affected, and we saw this earlier in the year. You got a massive miss on weather, and then it's pretty much given all back the next month. The guts of the report were probably weaker than the headline, but a bounce didn't surprise me. I think equities and the lack of any meaningful sort of participation really speaks to just how overly owned and how expensive that market and those trades are.
So how far do we have to go for equities to reflect what your call on this bond market is?
Well, I mean, I'm a little dubious of this, the narrative strand that talks about the need for a kind of permanently more expensive equity market for various reasons. So just looking at long-term average earnings multiples, you could still be talking about 25% equity downside just to get back to a sort of average earnings multiple for the US equity index. If indeed we see earnings forecasts and ultimately earnings coming down, then obviously there's potentially bigger downside there. That's in what I would call a normal kind of recessionary end of cycle environment.
James, one thing you've talked about in the last few weeks, away from this mess and all this chaos, is how little you believe the politics are relevant to this market going into November. Is that still your belief?
Yeah, it's funny, while you guys were talking about that, I was sitting here just thinking, wow, I haven't really thought about the election in the last week or so. Ultimately, of course, this stuff can and does matter. I just think, there's a lot of wood to chop before we get to the actual election itself, let alone inauguration in January and then the congressional timetable for passing legislation. So, of course, a new president can do some stuff with executive order. We've seen increasingly in recent years EOs being used more liberally to try and sort of circumvent fragmented Congress. But some of the sort of tax and spend type policies, they're going to have to go through Congress. So it's going to take time, particularly if Congress is split. So for me, the cyclical dynamics and what we're seeing playing out in front of us, that is to say growth, inflation, what that means for central bank policy, they're going to be much more relevant over the next 1, 2, 3 months. Maybe we can start to think about what January 25 looks like as we get closer to the event itself in November.
But James, when it comes to the White House, unilaterally, the president has a lot of power when it comes to things like tariffs. When will you start paying attention to potentially that part of the policy if you do think maybe it's going to be a Trump presidency?
Yeah, I mean, Anne-Marie, that's right. I mean, you go back a couple of weeks and Trump was seemingly a shoo-in at 70% implied odds if you look at something like Real Clear Politics. But of course, we've already seen that reverse. So if you'd gone all in on a Trump win at this stage, you would have found yourself having to backpedal already, because obviously we've had a bait and switch with respect to the Democratic candidate. So the uncertainty for me is sufficiently high that it's difficult to feel confident or comfortable positioning for those things when there are multiple other events that can move markets in the meantime. So yes, of course, I think if we do get to the stage where it looks like Trump is going to win, you have to start considering what the impact of tariffs is going to be. But even that, in and of itself, it's an unclear effect on a lot of asset prices, because there are other aspects of Trump's policy prescription which seem rather incongruous and inconsistent.
James, appreciate the update. As always, thank you, sir. James Nathie there of Marlborough, sticking with that long yen, long duration trade, talking about how great the cyclical risks are ahead of the election without talking about the politics at all. The good news this morning are things are a lot calmer. They've settled down. We're positive by 0.9% on the S&P 500. We'll see if it sticks. The lineup for the second hour of Bloomberg Surveillance looks like this. Katie Kaminsky of Alpha Simplex, Henrietta Trays of Vader Partners, Gerard Cassidy of RBC, and Neil Dutter of Renmac. That's up next. This is Bloomberg.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people are optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
If the Fed doesn't push against that tightening in financial conditions, you will actually end up slowing the U.S. economy by more.
Once they start to go, they're probably going to be going in a series of moves. I just don't see the need for a
kind of a panicked rush.
Calm is important in a moment like this, regardless of what indicator data points you're looking at.
When you're talking about 2 to 3 cuts, I think I would still keep that as our base case.
The Fed has the ability to cut. We are actually in a good place from a monetary policy perspective with room to run.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Live from New York City this morning. Good morning, good morning. Here's the tail of the tape so far this morning. Just a little bit better, things improve. Calmer, if you will. If that's the word of choice this morning, I'm not sure. Let's see how it sticks. We're up by 0.9% on the S&P 500. The Nasdaq up by almost 1 full percentage point. That's the equity story. In the bond market, after a big turnaround in yesterday's session, the 2-year yield at 1 point lower by more than 20 basis points and finished higher on the session as the ISM Services Index came in better than expected. And if you want to read in Japan, here's a read of things in Japan. After 5 days of aggressive yen strength, just a little bit of yen weakness, 145 on dollar yen, positive by 0.6%. And Danny, the turnaround we've seen in the Japanese equity market from the worst day since 1987 to the best day since 2008.
And the irony is the best day since 2008 doesn't even make up for all the losses that we've seen. Like, this is when you get disappointed. It's only a 10% rally. Does this shake all those people who just love Japanese stocks, the Warren Buffetts of the world that said that things were changing? Sure, we turned around, but a lot of volatility behind it.
Yeah, then we speak to Peter Cheer, who says, don't be cute. Don't buy this dip yet. He still thinks potentially there's still more unwinding and downturn to come in this market.
We've got a big lineup for you this hour. Look out for this. Coming up, we'll catch up with Katie Kaminsky of Alpha Simplex as markets bounce back from a 3-day sell-off. We'll speak to Henrietta Trays of Vader Partners ahead of Kamala Harris's announcing her VP pick, and Neil Dutta of Renmac on the case for a 50 basis point cut in September. We begin with our top story. Stocks rebounding after the S&P 500's worst day in almost 2 years. Katie Kaminsky of Alpha Simplex writing this. Long-term equity signals still remain positive, but the magnitude of the sell-off may spawn more selling as investors ponder if this is a correction or a potential sign of an impending recession. Katie joins us now for more. Katie, it's wonderful to catch up with you. What a wild couple of days in these markets. Can you just frame, you're a student of history like we all are. Historically, where does this rank for you the last few days in this bond market?
Well, I'd have to say it was one of the bigger moves, not the biggest. I'd say March last year was a bigger move for us. But what is very interesting to me is that trend signals have pivoted to long bonds. Perhaps the long reign of the short bond trade is finally over. And you're really seeing that everyone's trying to lock in those rates before we have the Fed moving in the other direction finally. So it was definitely a historic moment.
So we've been told repeatedly about reinvestment risk, Katie, and that's what you've just sort of alluded to. People have come on this program and said to people, you need to lock in the yield that's available now, lock it in for time, because once the rate cuts come, you're going to miss out on all of this. Are you saying that what we've started to see is cash migrate from money market funds to lock in yield at the longer end of the curve?
Definitely. And some of it is, as you're selling out of equities, people are saying, well, let's lock in the rates while we have a chance. I think what's hard about bonds is they're very convex in that when they move, they can move very quickly. So it's not like you have a couple of days to watch that move. Once there's a realization that something has to be done by the Fed in the fall, people react. The markets also selling off causes people to react. So I think you're going to see, instead of smooth moves in bonds, some pretty aggressive moves. And that's what we've been seeing the last 3 days.
Well, to that point, Katie, I wonder how we should think about data releases now. If this is a market that is long, you saw yesterday a scenario where something felt like it had changed, that this market needed good news to save it, not necessarily being surprised by the bad news, but needing to constantly be saved. Is that how we're going to have to treat every data print from here on out?
I think we're going to have to be very careful because what we started to see in June, and we started to see this type of behavior in June, the truth is a lot of weaker economic data has been coming out and trickling out over time. What shocked me perhaps the most is that you saw a reaction in periods like June, but this time you saw a very strong reaction, a much, much stronger reaction than you've seen in the last couple of months, which could indicate that we've hit some sort of trigger point where the narrative from worrying about inflation has shifted to worrying about weakness in demand, worrying about economic slowdown, which is a very different narrative than what we had earlier this year.
And after that, Katie, I mean, you just saw note after note talking about a sort of systematic nature of the sell-off yesterday, whether it be in bonds or in equities. Morgan Stanley saying that those trend followers have more to go in terms of selling the equity market. How much value do you put in those sorts of signals to try to just divine where the market goes this week?
Well, the truth is positioning always matters in the market when people are very concentrated, and that's particularly the case in the equity markets. We have very concentrated positioning, extended trends that have really been very strong. There's a lot of conviction in those positions, and when the sentiment shifts, when the trends change, that always causes a lot of turbulence. So I think that's something that you'll have to watch as people try to determine, has this narrative really shifted?
When it comes to the US dollar, it's been tricky. Where does it go from here? Why is it so unclear?
Oh, this is a hard one. I mean, the US dollar has been really hard. Several things. Sentiment has been shifting. Secondly, growth and the strength of the dollar based on the US economy is up in play. But you also have the issue that, really the dollar has been very tied to the hiking and easing policy. So right now it really feels like which of these three things is going to drive the dollar going forward, and it's not clear at this point.
Does that also mean that it's unclear about where the yen goes, even though we've seen this massive unwinding of this carry trade?
This is a good point because the yen has been the most successful trend for the last 3 years. It has really been a very consistent, we're doing something different. Right now, given what we saw, it seems to have been a pivot in that this particular narrative that has worked very well for the last 3 years may be over. Means that the carry trade has to readjust. It means that all currencies relative to the yen have to adjust. And I think that people are still starting to figure out what does that mean going forward. Will we continue to see this volatility?
Katie, you're cross-asset. We've heard a lot of excuses, reasons for the moves we've seen in the last couple of days. Growth scare, unwind of the carry trade. When you look across asset, do you get confirmation of a real growth scare in commodities?
Yes, we do. And what makes me nervous is that you see a pivot in positioning very similar to what you see across past recessionary or sell-off trades. You see long signals in fixed income. You see short signals in commodities. Both of these are commonly seen when you see sort of a sell-off, risk-off trade, and they tend to be the profitable trades when you go into a recessionary environment. So I think that's something to watch because if other asset classes are warning ahead, that's something that could indicate that this isn't over yet.
So you like momentum, and the momentum seems to be behind what I would describe as a disinflationary bust. Is that the right thing to get behind right now? And is gold an outlier with that in mind?
That is a very good question. I think that right now, given the direction of the signals, we do see some deflationary type tendencies. Shorter signals in commodities may indicate weaker demand. You see long positioning in bonds at the same time, which is just a risk-off trade. So for me, that is something that is a real risk. A deflationary event while inflation numbers are trickling down over time. So I think we need to actually think about deflation and what could that mean.
Katie, perhaps in all the asset classes we've been talking about, the one we haven't hit is credit. And credit's been a weird one because in past crises, it's been credit that leads the sell-off. That didn't happen this time around. It followed on, but you did see a very wide widening of the credit spread, some 53 basis points in 2 days for high yield. And that's when we start to get those fears. Does this muck up financial systems? Does lending become more difficult? Is it too expensive for corporates to dip in? Is it too soon to have those concerns about this credit market?
I think the challenge with credit is that these things often come in small waves. And it's not always going to hit every asset class and every asset at a time. What I would say is that you start to see information coming out that we could potentially have a recessionary trade and that conditions could be too tight. That doesn't mean that it's actually percolated into the credit markets yet, but it's something to watch because as we know in past crisis periods, we do see there's often a few indications of those prior to the event. So it's something you want to sort of be aware of, that just because it wasn't hit this time as much, that it isn't susceptible to more systemic issues should we start to see a recession or a deflationary environment.
Katie, appreciate your input, as always. Katie Kaminsky there of Alpha Simplex on bonds, stocks, Foreign exchange, what's happening in the commodity market as well. Danny picked up on high yield. I want to talk about credit spreads, what's been developing in credit. High yield spreads at the back end of July, 297. If you're not in the market, not familiar with these kind of numbers, on a historical basis, that is incredibly tight. So super tight credit spreads means very little credit risk in the minds of the investors that are buying this stuff. Let's park that. Let's think about the widening we've seen since then. We've seen about 80 to 90 basis points of credit spread widening in just a few weeks. Now, I get that the levels are still pretty low, at sub 400, but in terms of the rate of change, the pace and the size of this move in just a few weeks, that's more than notable.
Correct. And it's concerning, again, the level you could say, maybe it's not at a point yet, which companies are saying, oh, this is too high, the cost of capital is too high for me. But when you get this volatility, you have what you had yesterday, which is virtually every single company that planned to come to the market to issue bonds backed off. There was nothing yesterday. And that's when those fears come in. It doesn't need to be a high cost of capital. It just needs to be volatile enough that corporates can't get the refinancing or just the loans that they want into this market.
So one day, if that's not a problem, if that starts to turn into a week, into a month, then you've got a bit of an issue. And that reminds me of 2018. I think we all remember December 2018, when the high yield market just seized up. I'm pretty sure that in that month back then, there was no primary issuance whatsoever in the junk bond market in the United States. If you get a month of that, then the Federal Reserve's got a role to play, because this is about a disorderly moment in the market. It's not functioning properly. You have to step in and do something. A couple of days of it, it's not going to be a big deal to Federal Reserve officials, and I think that's been echoed by what we've heard so far from two of them.
Yes, and I also think that's why the intermeeting cut thing is kind of drove me crazy yesterday, because usually when they would do an emergency, it's because something was happening in the credit market, just plainly and simply because it has the most direct economic effect. And again, we did not see that yesterday. So you do need a more sustained period, to your point, because when we have seen the Fed step in, I mean, you can even look at COVID. They started talking about buying high yield and investment grade ETFs. Again, that's where the problem needs to stem from.
Yeah, not a market functioning issue yet. It could change, but we'll see. Based on this morning, things improved just a little bit on the S&P. If you're just tuning in, welcome. We are firmer by 0.9% on the S&P 500. In the bond market, yields are higher this time, not lower. We're up by 7 basis points on a 2-year, getting closer to 4% again on a 10-year, up by about 7 basis points on the session. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Uber are up more than 5% in the pre-market. The company reported better than expected gross bookings in the second quarter, underscoring resilient demand for its rideshare and delivery services. Investors had voiced concerns over Uber's long-term outlook following Tesla's announcement of its robo-taxi event in October. But Uber highlighted that autonomous vehicle ridership in the past quarter was 6 times higher than a year ago. And Palantir shares are surging after the software company raised its annual outlook. Sales for the quarter rose 27% as demand continued to climb for its AI technology. The company emphasized its work with the U.S. government and allies, including for defense and intelligence purposes. Palantir has also expanded its commercial wing, with sales rising over 30% year over year. And the Chicago White Sox hit an unfortunate milestone last night, losing their 21st straight game. They are now tied with the 1988 Baltimore Orioles for the longest losing streak in American League history. It's 4 games that season. The two, based on their current record, are on track to lose 124 games this season. That would be the most losses since the 1899 Cleveland Spiders, which lost 134 games that season. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, determining the Democratic ticket.
What she needs is a governor from a swing state that appeals to much more centrist voters. We're really about to find out if the vice president herself is a really good politician, because really good politicians say, what do I do to win?
That conversation up next, live from New York City this morning. Good morning.
Middle East, and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Lots of notes dropping into the inbox from the South Side. Here's the latest from Barclays, just on the Federal Reserve. The Fed is likely to recalibrate, not panic. They elaborate. They say, we believe last week's data will push the Fed to recalibrate to a softer jobs market, not pivot aggressively. They're cool now. 25 basis point cut every meeting, September through to the end of the year. 75 basis points in total by year end. It's kind of like the cooler, calmer head view of things from Barclays this morning. In the bond market, yields pushing just a little bit higher on a 10-year up by 7 basis points. In the equity market, just a little bit of a bounce following yesterday's big loss. We're up by 0.9% on the S&P 500. Under surveillance this morning, determining the Democratic ticket.
What it is a difference between a transformational campaign versus small ball. What she needs is a governor from a swing state that appeals to much more centrist voters. Governor Shapiro, I think, is the transformational pick here. If Governor Walz is picked, what that will show you is she's trying to shore up her own party and her own base. We're really about to find out if the vice president herself is a really good politician, because really good politicians say, what do I do to win?
Here's the latest. Vice President Harris expected to announce her running mate later on today, with Reuters reporting the top contenders are Governor Josh Shapiro of Pennsylvania and Governor Tim Walz of Minnesota. Harris now the official Democratic nominee after securing enough votes on a virtual roll call on Monday. Henrietta Trays of Veda Partners joins us now for more. Henrietta, let's get into this. The two decisions then, or rather the one decision of the two candidates, Governor Walz, Governor Shapiro. What do you think ultimately is the deciding factor to choose between these two?
I mean, unfortunately, I woke up this morning and restarted my phone. I had such a vivid dream that Walz was picked. I just thought for sure I'd missed a headline or something. I think the question is really which state do you need? What does Walz actually do for the ticket? I think it's maybe premature to count out Mark Kelly, the senator from a really critical swing state of Arizona, although there's a lot of tension on Walz overnight. And inside D.C., a lot of chatter around him. I think part of that comes from Speaker Pelosi singling him out. But she, if you listen to the full interview that she did with Dana Bash on CNN yesterday, she talks about all the candidates and really has a good point about how these are all good options for Kamala Harris. And the best case scenario here is that for the last 2 weeks, we've had 3 to 8 very prominent, relatively moderate or some left-leaning members of the Democratic Party coming out and echoing their support for Kamala Harris, which is really what you want going into this race.
Interesting you mentioned Nancy Pelosi. She says she has not also spoken to Biden since he dropped out. Interesting, she says that everyone's very busy. She doesn't have time, though, to make herself available for an interview. Henrietta, do you think Shapiro and Walz could really impact whether or not Kamala Harris is able to win Pennsylvania?
No, I think Shapiro is 61% approval in a state that is obviously purple and that Trump has been in the lead-in for the last couple of months, though Kamala Harris has wiped away his lead there in the latest polls. I think that if a 0.4% outcome is what it comes down to, you need to seriously consider Shapiro. My concern is that it fractures the Democratic Party. The biggest rift I've ever seen in the Democratic Party is between the Israel-Gaza conflict, and the prominence of that conversation threatens to usurp any other policy position or positive developments on the moderate side that you get from Shapiro, and a 61% approval rating, the focus on infrastructure and his response to specific infrastructure needs in the state. His response to the attempted assassination in Philadelphia, I thought was exemplary, but that all gets crowded out by the internal strife within the Democratic Party over Israel-Gaza.
Well, Danny asked this question earlier, and we should put it to you. Do you think what is going on within the Democratic Party and a lot of movement with progressives to make sure it's not Shapiro on the ticket is anti-Semitic?
I think the conversation about whether or not it raises anti-Semitic issues is really the problem, because as long as we're having that conversation, it doesn't matter whether it's anti-Semitic or not. You're saying it constantly. You're bringing up a measure of his religion, of Kamala Harris's husband's religion, about the tensions within the party. It just keeps the conversation alive. One of the concerns that I have is obviously that you have severe unrest in the Middle East right now, threatening to escalate substantially, and colleges are about to get back into session. You could easily see protests erupt again. As we head into November, that's just 90 days away. I think the conversation itself is a huge problem within the party, and it's unfortunate that Shapiro exacerbates that, but it is a reality.
So you talked about one of the bigger risks, the big macro risk that's obviously out of the hands of the vice president if things kick up in the Middle East more than they already have. Another one of them, Henrietta, we got a flavor of it yesterday, economic concerns, recessionary concerns. If those are more apparent, how much blame do you think voters will put on the vice president?
Well, I think it's a big mistake for the Trump campaign to come out and seize on a single-day loss in the market and say this is Kamala Harris's fault, because as we've seen now from the surge in Japan, that reverses the next day. I mean, we've been in this industry for 20 years. How often does that happen? So I think it's a mistake to tether it to the stock market. That is what Trump likes to do, however, so I would expect that to continue regardless. But it continues to be the case that the United States economy is the strongest in the developed world, historically low unemployment, rising wages. It's going to be hard outside of one-day flashes for Trump to paint the U.S. economy in a way that is somehow exemplary and new, while we continue to have, 3% and lowering inflation and a continued steady stream of economic confidence that is very low, but improving amongst Democratic voters and moderate and Republican voters' minds. The delta between Trump and Harris on the economy is only 5 points now. That's far different than it was a year ago, with double-digit gains for Trump in that situation. That's been largely erased.
But Henrietta, when it comes to the economy and it comes to immigration, even if Harris is starting to close the polls, when you look at the polling, most voters say that they felt more secure economically. When it comes to migrants, they felt more secure under the Trump presidency. How does she talk about the economy while also differentiating herself from Biden, which when you see in the polls, they lay the blame on Biden and Bidenomics for the rising inflation?
Yeah, they absolutely did. And Biden has taken a lot of arrows for Kamala Harris and for the whole Democratic Party over the last 3 years and just the last 3 weeks since he stepped aside. What's really interesting to me is this perception in the polls that Kamala Harris represents the moderate candidate in this race. You're seeing that in the flight of moderates and independents over the Harris campaign. That's really surprising to me, because I think the Trump campaign has tried to paint her as particularly progressive and liberal. It shouldn't be hard to do. A California attorney general, San Francisco elite, San Francisco liberal. I mean, those should be pretty easy talking points. But the polling across Pennsylvania, New York, and other swing states suggests that that is not how voters are seeing this. So it's a really interesting dynamic. We'll see if it holds the last 90 days.
Henrietta, appreciate your input as always. Maybe we'll be talking to you in a couple of hours once we find out who this VP pick actually is. Henrietta Trade's there, Aveda Partners. Stay tuned, expecting some news at some point today. I'm pleased you brought up the Kamala crash thing, because I found that absolutely ridiculous yesterday. What was that about?
Well, I mean, I guess it's saying, oh, Kamala would be bad for the stock market, but literally what you're doing is admitting that Harris is doing better than Trump. I mean, that's literally what you're doing, right? To say yesterday's action was because of her, you're saying, oh, our candidate's losing.
I think the better argument would have been that a number of economists have come out and added more probability that potentially, because of the weak jobs report and what we're seeing, we could be tipped into a recession. But I don't know, the Kamala crash isn't going to work. It feels like everyone's just throwing spaghetti at the wall, but I remain steadfast in what Libby Cantrell said. Have a cocktail, wait till after Labor Day.
I'd take the rest of the month off, apparently. Andrew Hoddenhorst coming out with a pretty bearish note, so let's get into this. Over at Citi, Andrew's looking for a 50 basis point rate cut in September. The title of this piece, it's not just one data point, goes on to say, the unfortunate reality is that a range of data confirm What the rise in the unemployment rate is now prominently signaling, the US economy is at best at risk of falling into a recession and at worst already has. Goes on to say that data over the next month is likely to confirm the continued slowdown, and that's why things are cutting 50 basis points in September. More on that in just a moment. Up next on this program, RBC's Gerard Cassidy on his outlook for banks with rate cuts looming. That conversation just around the corner from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The bounce back from yesterday's losses picking up just a bit. We're up by almost 1% on the S&P 500, on the Nasdaq 100, up by 1.1, on the Russell, up by 1 full percentage point as well. In the bond market, the turnaround incidentally started yesterday morning. Unlike the equity market, those moves yesterday morning did not hold. They turned around off the back of stronger than expected ISM services data, and the front end of the yield curve, yields ended the session a little bit higher. We add to it, up another 7 on a 2-year to 398.74. The turnaround from 8:30 Eastern, Danny Berger, absolutely phenomenal. I want to keep going back to it. We're sitting here together. We've got the yield curve making big shifts lower. The 2-year down by more than 20 basis points. And we both sit here and say, wait for the ISM. Let's see if the data confirms or denies. And the data did not confirm.
Talk about whiplash. I think part of it comes down to what Katie Kaminsky of Alpha Simplex was talking about, that this is a bond market that is now long. The risks are now asymmetric in a different way. The risks are now asymmetric to stronger data because we've all whipped up these sort of recessionary fears. And yesterday was a taste of what happens when data comes in and surprises us to the upside, because we've all gotten concerned about this labor market. So yeah, we have a lot of quietness throughout this week, but I mean, next week, talk about a big week for data. I mean, I don't know what we do with that. The risks are very high for another kind of whiplash session in this bond market.
CPI data just around the corner. That's what Danny's alluding to. Let's talk about Citi, because Citi came out with this note moments ago and I shared it with you. The last line of this note, Danny, keeping a 50 basis point cut in September likely and a potential intermeeting cut on the table. A deceleration in this economy, which Andrew says is not just one data point, it's a range of data that at best we risk falling into a recession, at worst we already have.
I understand his point. I think the one fly in the ointment is he's there, is the Fed there? Mary Daly and Austin Goolsbee yesterday both saying it is just one data point, and we don't react off of one data point. And Mary Daly also talking about the idea that it is equal risks between inflation and unemployment. Once they have their head around that, maybe they can get to 50 basis points, but they sound very far from it at the
And
moment.
they're the doves on the committee, Goolsbee, Daly. They're what many people consider to be the doves on the FOMC, and the doves on the FOMC right now aren't screaming, let's go 50, let's go 50. I think the Ellen Zentner note from Morgan Stanley is pretty revealing that they believe it's 25 unless we get a sub 100K print on the August jobs report, which we won't get until September 6th. That's the latest on the bond market. I just want to go to foreign exchange just briefly and give you a sneak peek of what's developing in the FX market. Dollar yen 145.41. So that currency pairs up by about 0.8%. What you see on the screen here is a weaker Japanese yen. Dollar yen over the previous 5 days, a move of more than 6%. The biggest 5-day move going all the way back, Danny, to 2008. Absolutely whipsawed in such a vicious fashion in this currency.
And I think so many people want to know, is this over? Has the knife fallen? And part of that centers around the carry trade, because that's what a lot of us really pinned this move on, that you had this big unwind to the carry trade and had all these consequences. We talked about this, John, that those trying to pin down how much further we go, it's tough because, okay, JP Morgan says 50%. We talked about that this morning, this idea that, okay, even if you've unwound 50%, do you undo the rest of the 50? Do you stay there? All these numbers are really difficult to grapple with. And in the meantime, I mean, do you really want to touch this Japanese market?
Yeah, there's a lot of this going on at the moment, isn't there? A lot of this in the FX market. Under surveillance this morning, some top stories for you. The government getting a win in its first major antitrust case against the tech giant in more than 2 decades. A judge ruling that Google illegally monopolized the search market through exclusive deals, saying payments to make its engine the default option on phones and browsers blocked competitors from succeeding. Anne-Marie, we've seen a lot of this, and we're probably going to see a lot more.
Likely going to see a lot more. We also have the second part of this. What does this mean in terms of penalties? What is the DOJ even looking for when it comes to these penalties? The remedies Google will need to make, we're still waiting on. But this 286 document, what the judge said is Google is a monopolist, period. And I think that said a lot of the direction of travel.
You know what I was thinking about? I'm curious, okay, they can't pay them anymore. We saw from the documents it was about $20 billion in just 2022. What a coup it would be for Google if they can't pay them anymore, but Apple and Android decide to still keep Google as the default browser. I mean, that's great for margins, but also, I mean, as a user, I think I'd be really confused if one day I opened up my phone and, I don't know, like DuckDuckGo is all of a sudden the search engine that comes up.
Don't you instantly choose Google anyway on a desktop?
Absolutely.
I always go to Google.
So maybe, I don't know, maybe the strategy already worked and it's great for them.
If it defaults to Bing, I'd go back to Google.
Yeah, exactly.
Again. Anyway, okay. Comes down to who makes the better product. At least that's personal view. Maybe that's not worth anything. Let's get to this. I want to talk about the commodity market just briefly. Crude yesterday, lower, and lower even in the face of this. The United States and allies hoping to avoid a wider war in the Middle East. The Biden administration moving additional forces to the region as concern grows over a possible Iranian attack on Israel in retaliation for the killing of top Hamas and Hezbollah leaders over the last week. Anne-Marie, phenomenal to see the growth scare in markets worldwide take over this commodity market and almost park the real risk that we all have to confront right now in the Middle East.
And it is a real risk because we already have seen one of our air bases attacked by Iranian militia west of Baghdad. You had Blinken getting on the phone, according to Axios, with his G7 counterpart, saying the attack could have came as soon as yesterday. Yesterday, Biden met with his national security team, and Axios was reporting that he was told that it's still unclear when Iran and Hezbollah are likely to launch an attack. But you've seen the U.S. move squadrons into the Middle East. You've seen them keeping that aircraft carrier. They want to maintain some level of deterrence and some level of defense because they are expecting. And Iran's new president already said, for sure, there will be a retaliation. But we're just not sure when, and we're not sure the magnitude.
Let's just draw a distinction between the two things. You talked about the timing briefly. Do we know about the character of the kind of attack, the nature of the attack that we're anticipating here?
Not sure, but potentially what we saw in April, it's going to be similar, directly targeted to send a message to Israel.
That's the latest in the Middle East. I want to turn to the latest in the financial markets. Talk about treasuries. We've talked about that briefly. Retreating after a major rally that saw two-year yields fall below that of the 10-year note for the first time since 2022. Then unwound some of that move. 398, just short of 4% on a 2-year. As this bond market makes this major move, the banks have been all over the place. So in 4 sessions, we've had JP Morgan lower by close to 10%. In 4 sessions, we've had Bank of America drop by more than 11%. To talk about some of these major moves, Gerard Cassidy of RBC Capital Markets joins us now for more. Gerard, I guess what we'd love is just your initial reaction to the summer moves we've seen for some of these large cap mega banks on Wall Street over the last 4 days, and it's been pretty brutal.
John, it certainly has been very volatile, no doubt about it. But what's interesting to me is that the underlying fundamentals for the banks are still strong. The second quarter results were good. I don't know if you saw yesterday, John, the senior loan officer survey came out, and loan demand is actually picking up, and the banks are easing their lending standards. And as you have pointed out here, if rates are coming down, that's going to help solve one of the problems the industry is confronting, which is commercial real estate refinancings. So it's interesting, the volatility, and we understand that, of course, because of the volatility in the markets. But if you're confident that we're not going into a hard landing, these are good buying opportunities.
So, Jared, we've got to get into the rate story. For a long, long time, when we had rates that were super low, all we heard was complaints. Are we now saying that we need lower rates for these banks to perform?
What would be very beneficial, John, is if the front end of the curve could come down slowly. As you probably can recall, the funding costs for the banks are now peaking. At the same time, though, the cash flows coming off of their asset side of the balance sheet, think back, if you will, when they were purchasing bonds and making loans in 2020 and 2021, they were purchasing bonds at less than 1%. Well, those bonds are going to be paying off over the next 12 to 24 months. And as they pay off, they're going to be going into higher yielding securities, even though their funding costs now will start to come down as they cut the Fed funds rate. Plus, if you start to see a steepening in the curve, that's also positive for the banks.
I want to talk about another side of their business, and one they spent a lot of time in their earnings talking about, Gerard, and that is M&A. This M&A renaissance, many of them have talked about, and how much it's going to support their business and the beginnings of it. If we have more days like yesterday, if this is a more volatile market, if this is a market where credit spreads are starting to widen, is that M&A comeback going to be as forceful as so many think it will be?
It's going to be interesting because the pipelines were building up. There was more confidence that M&A was coming back, but you're right. If this volatility continues throughout the second half of the year, it makes it more difficult for that M&A environment to pick up for the investment banks. That being said, though, lower rates will make it more attractive to do deals because the cost of funding will come down. So there'll be obviously some negatives with the volatility, but the positive could be that the lower cost funding helps do deals that maybe couldn't have been done with the higher interest rate environment of 3 to 6 months ago.
Fair enough. Okay, then how do I evaluate a bank like Goldman? And I mean, you can take any of these banks, the ones that have really been pivoting towards not investing on their balance sheet, but other people's capitals, building up these huge private asset business. Is this a good environment for them or a bad environment for them?
Actually, it's quite strong. As you take a look at their trading results versus their investment banking results, I know the investment banking results always grab the headlines, understandably so, because it's always big news when a big deal is announced. But the real driver of revenues is trading, and volatility brings on more trading. So you might recall, sadly, when Russia invaded Ukraine, that quarter's trading revenues were very strong for all the investment banks. And think about what John just mentioned about volatility. I gotta believe the trading revenues are picking up very strongly for these companies. So if the volatility continues into September, we could see a very strong trading quarter for these big banks.
Gerard, Danny brought up M&A. I'd like to get a sense from you how you're thinking about how these banks are going to perform, or sectors within the bank are going to perform, based off potentially who we're going to see in the White House next year.
It's a really good question, because under the Trump administration, when they were in office from obviously 2016 to 20, it was a very favorable regulatory environment for banks. And we expect that should Trump get reelected, that kind of favorable environment will come back, and there will probably be more M&A. But even under a Harris administration, assuming she is, of course, the Democratic nominee, I would say that we'll still see probably a better environment. And the reason being is that the regulators understand that the banks can do deals and make cost-effective decisions and drive those economies of scale, but at the same time, be very supportive of their customers. And so that's what they have demonstrated in the past, and they'll demonstrate in the future. So we expect M&A for the banking industry to pick up in 2025. But if this volatility continues, that would probably put a dark cloud over M&A for the near term.
See, that's the thing, Jared. We got to get there first. And I wonder if the attitude, if we just kind of park the volatility to the side, is the attitude of these financial institutions at the moment, we got to hurry up and get deals done before there's the election, or is it we're just going to sit back and wait until after November?
I think it's going to be depending on the deals. I don't think anyone's going to rush to get anything done before the election. These deals have to be well thought out. And obviously there's discussions probably going on outside of the banking industry and the traditional M&A markets. And it really comes down to, does it make sense? One of the big interesting parts about M&A is that the sponsors, the Carlyles, the Blackstones of the world, their portfolio companies, they have been reluctant to sell them because the valuations are not at the levels that they recall back in, let's say, 2021. And so I think the markets, up until very recently, and this volatility maybe disrupts this a bit, but up until this volatility, the markets were very capable of handling M&A activity. It was just the sellers were reluctant to sell. So we'll have to see how that plays out through the end of the year and into next year.
Gerard, just quickly again, top pick this morning. What would you buy after the recent sell-off?
I would say after the recent sell-off, John, Bank of America looks very attractive. You pointed it out, it's down 11%. JP Morgan also looks attractive, as does Goldman Sachs, all three of them.
Quite a correction in the last few days. Gerard, thank you, sir. Gerard Cassidy there of RBC, down more than 11% on Bank of America in just 4 sessions. Unbelievable. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. UK Chancellor of the Exchequer, Rachel Reeves, has declined to rule out increasing the capital gains tax. In an interview with Bloomberg TV, she warned that difficult decisions will be taken to fill a $28 billion budget black hole. She says the UK will strike the, quote, right balance on tax in the budget due October 30th. AI darling NVIDIA is dealing with some engineering issues. According to people familiar with the situation, the company's upcoming AI chips will be delayed due to design flaws. The delay could be 3 months or more, affecting NVIDIA customers, including Meta, Google, and Microsoft. In a statement, NVIDIA says it doesn't comment on rumors, and production is on track to ramp up in the second half. NVIDIA is up in the pre-market after losing 6.4% yesterday amid the sell-off. And Boeing executives are back on Capitol Hill today. They're facing the most extensive hearing yet about the fuselage blowout back in January that exposed multiple quality lapses at its factories. The National Transportation Safety Board is spreading the questioning over 20 hours today and tomorrow. Since the accident, Boeing has named a new CEO. It's agreed to buy back its supplier Spirit AeroSystems, and it's pleaded guilty to a conspiracy charge from 2 previous 737 MAX crashes. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, the Fed staying cool, calm, and collected.
We've now confirmed that the labor market is slowing. We will make policy adjustments as the economy delivers the data so that we know what is required.
That conversation up next. Neil Dutta, just around the corner.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks on the S&P 500 up by 0.7%. Just a bit of a bounce following the losses of yesterday. Yields are higher by 5 or 6 basis points. The 10-year 3.8465, and the yen weaker this morning, 145 on dollar yen. Under surveillance this morning, the Fed and Fed officials staying cool, calm, and collected.
From my mind, we've now confirmed that the labor market is slowing, and it's extremely important that we not let it slow so much that it tips itself into a downturn. We will make policy adjustments as the economy delivers the data so that we know what is required. If we reacted on one data point, we would almost always be wrong.
Here's the latest. Fed officials acknowledging softness in the labor market, but falling well short of endorsing emergency policy changes. Neil Dutta of Renmark writing the following: the time for debate is over. The Fed needs to recalibrate policy now. Our call is that the Fed delivers a 50 basis point cut in September, with at least another 50 basis points of cuts spread across the next 2 meetings. Going more in September makes up for not going in July. Neil joins us now for more. Neil, I said the Fed's being cool, calm, and collected. Some people watching might say cool, calm, and complacent, but you say the following, and I think you know in the last week, following payrolls on Friday is an important one. You said they've stepped on a nail, not a bed of nails, and you went on to say this is easy to fix. Neil, why is this so easy to fix?
Well, thanks for having me on, John. I think it's easy to fix because there's nothing structurally wrong with the U.S. economy. Everything that ails the economy is a function of tight monetary policy. I mean, nobody's talking about a troubled asset relief program. No one's talking about a resolution trust corporation. So, I think that that's important to keep in mind. What we're dealing with is simply a function of the Fed keeping rates too high. And that means that lower rates can be the solution to what ails the economy. I think for the Fed, it's important, they talk about not wanting to make one data point too important, but it feels like that's what they're doing. I mean, you already see this with the debate between 50 or 25 in September. Well, you know, if the jobs number comes in strong for the August reading, we'll go 25. But if it does what it did last month, we'll go 50. I mean, that's ridiculous. We already know the revisions to these numbers are negative, right? So whatever the number is, it's gonna be weaker, you know, in hindsight. And the unemployment rate continues to march higher. And we know that the momentum under the economy is weak, and we know that there's an asymmetry with respect to how you know, firms deal with bouts of market volatility. Higher market volatility spooks them a lot more than lower volatility makes them feel good, typically. So, you know, I just think I've been saying it, they need to get on with it, but I think the longer they wait, the more they'll end up having to do, which is why I say that not only will they go 50, but I do think they'll go at least 50 more in the final two meetings of the year. So that's sort of how I'm thinking about it. But as I say, I mean, I do think the markets will respond reasonably well to lower interest rates, and I think that will you know, help stabilize the economy.
Credit to you, Neil. You've been calling for this for a while. I just want to pick up on an important distinction. I hear from you loud and clear what you think they should do. Do you think they are dependent on that jobs report in August on going 25 versus 50? Do you think it comes down to that?
I mean, it seems that way. Look at the Wall Street Journal this morning. You know, they had an article talking about how the next employment report is going to basically determine whether or not they go 50 or 25. But, you know, Powell has also talked about how it's the totality of the data. What if core inflation comes out very soft in the next report for July? You know, I think that there's a reasonably good chance of that happening, given what we know about the deflation in cars, the cracking in housing rental inflation, and the ongoing weakness in non-housing services. There's good reason to think that we'll get another dud on core inflation. So now, not only is the employment figures weakening, but core inflation is converging onto 2% more rapidly than they thought after the first quarter. So it's also about the outlook, right, John? I mean, what's the upside case for why employment will pick up? We get a weather bounce back? I mean, it's crazy. Housing is slowing. If you look at the number of new homes that have been sold that haven't been started, that's down over 30% against last year. That's going to bleed into single-family residential construction. It's unlikely that we get the kind of inventory investment rebound that we got in Q2 in the back half of the year. That's going to weigh on manufacturing, and total hours worked in manufacturing already slowing over the last 3 months. And the fact that the labor markets have slowed means what? Incomes are slowing, which will take some of the upward momentum out of consumer spending, which the Fed has been optimistic about. So it's not about just waiting for this data to come out. It's also about thinking about what the outlook might be. You know, in my mind, the data already justify a 50 basis point move. I mean, the fact that the unemployment rate is up to 4.3%, that's 30 basis points higher than where they think it's going to be by year end. You put that into a standard kind of Taylor rule model, you get at least an additional 60 basis points worth of rate cuts. So it's not about just the data as it's come in, though they keep wanting to make it about that. It's also about the economic outlook. And, you know, I don't think there's really a right tail for growth. I think the distribution of risks is skewed to the downside, and it's important for the Fed to neutralize those downside risks by easing monetary policy.
Yet, Neil, Mary Daly yesterday saying that risks are equal between employment and inflation. That does not sound like a woman who's ready to cut 50 basis points in September.
Well, that's what I said, and I mean, I mean, you're right, and I do think the Fed has a role to play here in trying to get on the right side of the 8 ball. But what's happening in the markets, I mean, leaving aside the sort of unwind of positionings and things, I mean, the big move in yields happened in the 2 days following the meeting. Why? Because the data was weak. You know, the risks aren't balanced as much as they want to. This is really about them. It's not about them knowing something the market doesn't know. This is about them realizing something the market and most investors already do know. And that's why I think, you know, you're in this point now where if you get bad data, it's going to lead to bad market outcomes, because anything at this point that looks weak in terms of the economy will kind of fuel these bets that the Fed's behind the curve.
Bad news has been treated.
The markets already know, guys.
as bad news.
Bad news.
Bad
The markets already know that the risks aren't balanced. Whether they say it or not is another matter.
Just waiting for the Fed to catch up, Neil. It's good to hear from you. Neil Dunter there of Renmac. Appreciate it, sir, as always. Neil's framed this perfectly over the last week or so. Going into that Fed decision, you've got to ask yourself, and this was last week, before Wednesday, what is the greatest risk here? That unemployment goes higher or inflation reaccelerates? And for Neil and others, the risk is pretty clear. It's the former and it's not the latter.
I think it's fair, framing it, what would accelerate inflation, and having a hard time really getting anything that would get you there. Again, the issue, though, comes from, is the Fed just behind in all of this? Neil is talking about the Wall Street Journal, writing that they're deciding between 25 and 50. You had a Fed chair, Jay Powell, who wouldn't even say that a September cut was happening. I mean, there's this really hilarious point in the press conference where he says something like, a cut wouldn't be political. Not that we're going to cut, by the way. So, I mean, he's not even fully endorsing it himself.
Just how quickly the conversation's changed. We reflected on this yesterday. At the start of July 2nd, Chairman Powell's in Sintra, Portugal for the ECB get-together, and he's talking about a strong labour market being a reason to wait, a reason, justification to be patient, to get this right. And a month later, you get that jobs report, and the conversation changes so quickly. Has it changed that much for the Fed? We'll wait for more Fed officials to hear from them. The third hour of Bloomberg Surveillance is up next. We'll catch up with Jim Karen of Morgan Stanley, Oliver Chen of TD Cowen, Christina Campmany of Invesco, and Michael Feroli of JP Morgan. Mike looking for 50 from the Fed in September. All of that up next.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's never been done before. And it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This quick turn from markets from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down.
This says as much, probably much more about market positioning as it does about how much the economic data has changed.
I think we all need to calm down a bit. This is a process, and this is very natural for markets.
All in all, I think this will turn out to be more of a technical aberration in the market.
Our number one highest conviction trade for 2024 coming into the year was volatility, and we're seeing it.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Just an absolutely brilliant, fantastic lineup of guests in the last 24 hours. Earl Davis of BMO there, long volatility coming into 2024. Well, coming into summer, that's worked out big time, particularly in the last 24 hours. Lindsay Rosen of Goldman Sachs Asset Management saying, deep breath, stay calm. The right advice. We bounced back this morning. Let's see if it sticks. I keep repeating that. We're up by about 0.8% on the S&P 500 yesterday, down 3 full percentage points at the close on the S&P 500, the biggest one-day drop going back to 2022. If you switch up the board and turn to the bond market, I'll give you a flavor of things at the front end of the yield curve. The 2-year back to about 397 after dropping into the 360s at one point yesterday, which is just a remarkable turnaround from where we were. We're up 5 basis points on the session at the moment, approaching 4% all over again. We have to talk about the data and just take stock of where we've been over the last few sessions. So on Thursday, we had ISM manufacturing, the wrong kind of read on that particular data point. Jobless claims were higher than expected as well. Then payrolls just sort of poured gasoline over the growth scare. Then we come into yesterday, and we're all talking about the same thing. ISM, 10 a.m. Eastern Time. Look out for ISM services. That's the important one. That comes out better than expected. Bond market turns around. Equities almost just sort of ignore it. Ignore everything that's taking place there. And I found that divergence interesting yesterday. Bond market recovered just in terms of where yields were. They came back into positive territory on the session. And the equity market losses stayed.
Yeah, the equity losses stayed, but at 3%. I mean, they were down, and they were down more than we have seen in quite some time, just because this equity market has been chugging along. But we've been talking about this idea that you get a VIX go to 50, you have equity futures in the morning sell off some 4%, and everyone that came around this table said, be calm. Everybody in this market was, for the most part, calm. So have we really had that capitulation moment? Probably not.
Well, I'm just looking at also what Andrew Hollenhorst, and you brought us that note up this morning. He does not sound calm about where the economy is going this morning. U.S. economy at best at risk falling into recession, at worst already has. He's not even just talking about 50 basis points in September, which we just talked to Neil Dutt about. He's talking about the fact that there is this potential on intermeeting cut on the table. Could the Fed move before September? What kind of data do we need to see in the next few weeks for the Fed to come out and make some emergency cut?
One of two things. You need to see massive moves in the market that become disorderly, stop the functioning of credit. We talked about that briefly and reflected on the experience of December 2018. On top of that, you'd need to see the data absolutely collapse. Basing that on Thursday and Friday, and on a couple of days of price action, I find it to be a massive stretch, and I think a lot of people agree with that view.
Well, so two things. One, what would that do to Fed credibility if they decided to do an emergency cut just because the market fell? Two, what would that do to the yen? I mean, what would that do to the whole thing that really whipped this thing into a frenzy? If you get the Fed to cut, presumably the carry trade unwinds, I don't know, whatever the rest is we have in it, and you get appreciation, and then stocks sell off, and this whole thing just starts over again.
Yes, a massive feedback loop. It's sort of been feeding on itself, on each other. Those two stories, the growth scare back into the unwind of the carry trade, back into the growth scare, et cetera, et cetera. We've seen it repeatedly. The good news, I guess, over in Japan is that dollar yen is higher. It's back to 145, which is interesting because a few weeks ago that was a problem when it was at 160. They were uncomfortable with the move higher, and now they're comfortable with the move lower. I don't know where the BOJ is on all of this. this. 145.12 is where dollar yen is. That's positive by about 0.5%. Just want to reflect on what's happened in the Nikkei 225. Japanese equities all over the place. Yesterday down by 12.4%. Worst day since 1987. Today higher by more than 10%. Best day since 2008. And Danny, you touched on it. The unwind of the carry trade. How big is this thing? How much more needs to be unwound? How much more should be unwound? JP Morgan taking a stab at things. The carry trade unwind, at least within the speculative investment community, is somewhere between 50 to 60% complete. That was in a conversation we had overnight on Bloomberg TV. I wish I was a part of it because I've got no idea where these numbers come from and what it all means.
Right, because I also saw numbers on Friday saying that if you look at CTSC data, it looks like it's pretty much done, and then you get a day like Monday. So part of the problem also is not even just the carry trade itself, but trying to understand what things are connected, because we decided pretty quickly that it was connected to big cap tech, that a lot of people were using it to fund the tech trade. And again, that's another beast we don't fully understand. So in trying to decide when it's over, you kind of need to know those things to get your hands around it.
It's fair to say we've got a lot to figure out. Coming up this hour, Jim Karen of Morgan Stanley as futures bounce back from a 3-day sell-off. Christina Campmany of Invesco on why she's still negative on the US dollar. And Mike Farley of JP Morgan on why he thinks the Fed is going 50 in September. We begin with our top story. Stocks rebounding from a 3-day global slump. Jim Karen of Morgan Stanley saying the sell-off is a correction rather than the start of a bear market, writing the magnitude is not unusual, but the speed at which it's happening is. As long as we have a soft landing, then we think the sell-off represents a reset of prices, a buying opportunity, but cautiously, patiently. Jim joins us now. Cautiously, patiently. Jim, let's get into this. Did we learn more about positioning than we did about fundamentals in the last couple of days?
Absolutely. I think that this move in the market has a lot more to do with positioning, over leverage in some cases, volatility, than it does the economic fundamentals. And look, you were just talking about it on the show. I mean, we have a yen carry trade that's going through. We have, other crowded positions. Now, we have to recognize that the markets were in a period of very low volatility. I mean, the VIX, just a month ago was somewhere around, 11 or 12. 24 hours ago, it went to 65. And effectively, that is a significant move which causes people to de-risk very quickly. So the low volatility period allowed people to build very crowded positions and actually get rewarded for them. So I think what stops this, and this is always the question mark, is when an asymmetry starts to appear, meaning that there's more upside risk than downside risk, or the upside and downside risk components balance. Where is that level in the market? It's hard to say. Because like you were saying, that there are many of these positions still probably need to get unwound. So yes, we may have a reprieve today. Yes, we may bounce back today, but that only may give people the opportunity to sell again in order to get their positions and their volatility more squared. Even if you look at the put-call ratios in the equity markets and everything, I mean, we're talking about moves. I mean, you said it earlier. I mean, we had 1987, for the Nikkei, type of a move, and then 2008. This is like the stock market crash of 87. This is the financial crisis in 2008. These are the types of moves we're having today. I don't think the economic fundamentals justify 1987 or 2008 to justify these moves. And I think what people are looking at is they're looking at these moves and they're extrapolating from these moves a fundamental economic story. I think the fundamental component of this is very slow moving. Yes, things are slowing down. Yes, policy rates are high. Yes, the Fed's likely to cut rates this year, but I don't think it necessarily derails, where we were before. So I think that this is somewhat overdone. Doesn't mean that we can't go down, but if it does, I still think that we are in more of a secular bull market. This is not the start of a bear market. And we are going to be looking at opportunities to add to risk. In fact, what we're doing on our team at Morgan Stanley Investment Management is we are going on we're creating our list, right? We want to shop on sale. We want to find many of the positions that we weren't able to get into that have run away from us to high prices that might be on sale and might be looking interesting. So there are opportunities out there, but you've got to be cautious, patient, don't do it all at once.
Let's unpack some of that then. What's on sale right now, has been on sale over the last few days, that you've dipped your toe into, that you like and have started to buy?
Yeah, well, I mean, one of them has just been broadly the the Nikkei Japanese equities. I mean, that's one. Now we were long that. Now, don't get me wrong. I mean, we got long that in March of 2023, so we've been riding that up quite a bit. But like anything else that goes up, we weren't long enough. So with some of the setback, these are things that we started to take a look at. Other things like some of the semiconductor stocks in those sectors start to look relatively interesting to us. Looking at factors. So thinking about quality. So we like to think about buying quality, but at a reasonable price. So this is, these are balance sheet factors, strong balance sheet companies, and high quality factors, interest coverage, things like that, are just looking more attractive today, where even if we want to broaden out our portfolio, diversify it more away from large cap and big tech, I think that there are some good segments of the market and some good quality factors that are out there that actually represent that can actually represent an opportunity. Now, what I do think is a little bit overdone, though, to fund some of this is a bit of the move in the interest rate markets. I think the bond yields have priced in Fed cuts going down to 4%, maybe even 3.5%, depending on how you want to look at it. I think the bond market has moved quite aggressively. And even if you look at the bond market from point to point, if we look at the start of the year this year, 10-year Treasury yields were about 4% on January 1st. Today they're at 3.85. Okay, so clearly there's been move up in yield in between then, and now it's come back down, and the speed of the move. But point to point, the bond market is actually relatively steady. It's giving you a nice little coupon, and returns are up around 3% in fixed income, which is okay, right? And this is kind of what you want. But the point though there is that most of this right now, most of the return is now coming from the yield move lower. And I think that might be a little bit on the overdone side. So we may fund some of our equity positions by selling some of our bond positions because interest rates went down so much and the prices appreciated quite rapidly.
So if we're in the secular bull market for equities, bonds have moved too far to 3.85. What is more reasonable, Jim? What's sort of an analogous trade to what you see on equities?
So, I mean, the way that I kind of think of it as a range type of a trade. So for me, the level 5,200 in the S&P 500, represents the beginning levels that you would want to start to think about buying. And the reason I say that is I key everything off of what I believe is a level that's more fair for equities today. If I look at the S&P of around 5,350, and that's roughly 19.5, PE. That's a 19.5 multiple on 275 earnings pulling forward from 2025. So if I think about the overshoot that we've recently had, that went up to 5,500, 5,600, and I think about that more symmetrically, it tells me that 5,150 to 5,200 on the downside from that 5,350 center actually starts to look relatively attractive. So today it would look like we're a little above that. But like I was saying earlier, with this rally in the market, what this may do is it may give some of those positions that still needs to be unwound the opportunity to sell into some of the strength, and they could push prices back down. But that's where the asymmetry begins. Around 5,200, around 5,150 in the S&P 500. I believe the upside potential for markets relative to the downside, even if you have a deeper correction in equities, becomes more symmetrical. So that's where I start to pull out the buy tickets. And that's what we're looking to do at this point. Now, if I thought we were in a secular bear market, if I thought this was going to be the start of something really big, now then I wouldn't do it. I mean, I would think that, the downside has a lot more room to go. But that's not where we are. In my view, I think the economy is cooling. It's not collapsing. Yes, earnings may start to slow as forecasts come out. Unemployment rate rises. There's less strength from the consumer. Certainly, that's going to be a little bit of a drag. But in many cases, I still think that the jobs market is going to maintain relative strength. The people who are very bearish on the bond market, or I should say on the equity markets, are people who believe that the unemployment rate is going to 5-6%, right? That we're going to have this major adjustment higher. There's going to be this big layoff spree that's going to come through. Right now, layoffs aren't actually showing any real meaningful acceleration. Yes, I mean, temporary workers aren't being hired rehired as quickly, and there is some softening in the labor market. That's good for the Fed because it lowers wages, and lowering wage inflation keeps inflation down. But I don't think necessarily it's an overall collapse in the market. I view it more as a normalization. And we have to draw that distinction. Is this a significant negative change, or are we just normalizing? And I think we're more or less normalizing at this point, but there's going to be overshoots to the downside, and I think those overshoots can represent buying opportunities.
And yet, Jim, here we are. I want to squeeze this in because I think this is so important. You say that what we've learned in the last few days is we've learned more about positioning than we have about fundamentals, and I think a lot of people might agree with you. I just want to reflect on what another Jim said earlier this morning over at Deutsche Bank, Jim Reed. What a once-in-a-lifetime GFC period could not do, and a liquid August day in 2024 with one bad weather-related payrolls print for fuel did, with some ease, for a period of time yesterday. What would have happened if we'd seen a negative payroll print? Jim, I've got to ask this because I just wonder how fragile this market actually is. So if you're saying this is just normalization and nothing nefarious, I wonder what happens to this market when we do have to confront something more nefarious. Just how unstable are things, Jim?
Yeah, listen, I think it's a good point. I mean, if we have a material deterioration in the data, then I would argue that, yes, I mean, maybe there is something bigger that's going on. So if I compare that to many of the crowded positions that are likely still out there, look, we could have another 5 to 7% downside correction. It's not uncommon to have about a 10% correction in the equity markets. I mean, this is kind of a normal thing that, that happens on a regular basis. But that, I think that kind of misses the point. I mean, if we start to get something in excess of a 20% correction, that's typically the signal where a bear market might be starting, or there might be something bigger that's actually taking place. But right now, when you look at corrections, 8, 10%, 11%, which is what we've roughly had over the past 48 hours, let's say, Monday and Friday, this isn't something that is overly unusual. And I think that we as investors need to be patient, and we need to take this in stride a little bit. And that's why I keep going back to this, right? We have to ask ourselves the fundamental question. Is this the start of something bigger, and is this a bear market? Is that what's happening right now? Are we going to see an absolute collapse at this point, and sudden stop in economic activity?
Yeah.
Is that what's happening right now? If it's not, then I still think that the bull trend is intact, and we want to be able to find places to buy.
Got it. Jim, enjoyed this. Thank you, sir. Jim Curran there of Morgan Stanley, his view on what's been happening and where he wants to be. Up next on the program, the Morning Calls Plus, we'll catch up with Oliver Chen of TD Cowen on the state of the consumer. That conversation is just around the corner. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
could face bigger challenges next.
It was going to keep bringing the World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Counting it down to the opening bell, 1 hour and about 10 minutes away, with equity futures bouncing back just a bit. We're up by 0.8%. Let's get you some morning calls. First up, D.A. Davidson, raising its price target on Palantir to 28 from 24. The analyst citing growth acceleration due to persistent demand for AI solutions. Your second call from Morgan Stanley, lowering its price target on shares of Amazon to 210 from 240. The firm removing Amazon from its top pick list following last week's, quote, disappointing results. And finally, TD Cowen raising its price target on shares of Walmart to 80 from 75. Analyst Oliver Chen saying the company is well positioned to continue momentum across a leading retail tech ecosystem. That stock is up by 0.25%, and we're lucky. Oliver Chen's in the studio with us. Oliver, good to see you, sir.
Great being here. Thanks, John.
Does Walmart win and everyone loses? Is that what's happening here?
We're excited about Walmart because it's both defensive and offensive. On the defense side, it's a leading grocer. Everyday low price is a key strategy. On the technology side, there's a lot happening to compete against Amazon, including digital marketing as well as advertising and marketplace models and platforms. So thinking about technology married with the basics of retail and features such as curbside pickup and getting a higher household income customer. And it's a low beta defensive idea in this very choppy market.
I wonder, as people trade down, if they trade down even more, and how big of a threat is, you know, Temu, Shein, some of those kinds of names to Walmart's business?
Yeah, you're bringing up a great point. So consumer discretionary, unfortunately, has been in a recession for over a year. Temu and Shein are spending a lot on advertising. That's impacting Amazon, and the consumer discretionary trends are negative at both Walmart and Target. But it's a smaller percentage of total because Walmart is about 60% food. So we're watching that, and that's been happening. Target is more vulnerable. Target is also less expensive at 13 times relative to Walmart at 25 times. But there's a revolution taking place. Ultra fast fashion and what these new business models are doing are something the whole retail industry is watching.
Do they have the capability to catch up to that, to go on these trends that seem to change week by week of what people tell you to wear on TikTok?
Well, Walmart's getting more fashionable, doing movies and upgrading the fashion. They have a huge opportunity to sell you more than just basics, more than just underwear and fashion. They're also upgrading private labels. So new labels like Better Goods has a cauliflower crusted pizza. We're just looking at that. And so we're seeing Walmart really intensely focus on merchandising. That's a big positive too. Also, they're getting a higher household income customer. And we see that in our survey data too, because you don't even have to go in the store. You can get on the marketplace, you can also get Apple products and Burberry Goddess, the fragrance. So we're seeing this whole transformation with merchandising getting more competitive, but Walmart really rising to the occasion.
If Walmart is taking some of these higher end consumers, where are they leaving to go to Walmart?
Well, they're taking share from many places. So I think trade down is occurring as customers think about value and appreciate value. What's happening generally in supermarkets, it's quite fragmented. So the most pressure is at local chains and non-national and others.
Are we starting to see this stress migrate to higher income earners? Because we're starting to see some bad results from luxury.
Yeah.
And I'm not convinced it's just execution from the Gucci's of this world. It seems to be pretty broad. What are you seeing from the luxury players now?
We're cautious. So our only big idea here is LVMH, which is a $90 billion revenue company. But the big caution factor is China and the property market, and that customer is so important. The other factor, correlations are quite tight to the S&P 500 performance. So the negative headwinds from the wealth effect on this pullback are going to be something to watch for sure. And we see weakness in bridal trends. So we're cautiously optimistic. However, we're out this morning with a note on retail's reset. And we like structural long-term growth opportunities on the pullback, including LVMH, ELF Beauty, and Ulta. Beauty's been a good sector.
I'm just thinking of certain consumers, certain companies that have started to pivot to premium over the last few years. It's all we've heard about coming out of the pandemic, and which companies are going to be caught offside. The demand's just not going to be there. Who's vulnerable?
Well, we're still watching Kering. You know a lot about the Gucci brand. That's a brand in transition. And we've talked about this before, stealth wealth, quiet luxury, these no logo trends, they're really working. So there's winners and losers. We're most excited about LVMH, the powerhouse brands, Dior and Louis Vuitton. They spend $10 billion in marketing. That really matters. And Arnault really protects his brands for the long term with very little discounting. Gucci's a brand in transition, so we're hopeful. And Cartier, we're not recommending Richemont, but hard luxury has been more timeless generally. And thinking about timelessness is a key factor of what new generations really care about.
Do you like LVMH because they have a service component? It's not just luxury goods, they also have hotels.
Yeah, I think the future is experiential and thinking beyond just collecting stuff. The core of the business is fashion and leather, but service and these fabulous stores that are much like churches around the world to these brands are part of the magic. And luxury does have to be emotional and offer you really that post-purchase, pre-purchase, and the whole transaction being very special to really overpay a lot for great stuff.
Are people not getting married? What's up with bridal trends?
It's been a tough compare. So bridal's been tough, and that's been tough on Tiffany.
I was just going to say.
It'll happen. I mean, people will love each other and get married.
Thanks.
But people are, younger generations are generally getting married a little bit later.
Yeah.
It's something we're watching. And many ways to express love, from travel to other things.
Very true.
And the blueberry pound cake at Costco, we love Costco
That's
too.
another way of expressing love. People will still love each other. Thank you, Oliver Chen, TD Cowen.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You know, after a sell-off like yesterday, you just want to hear someone say, you know, people will still love each other. Oliver Chen at TD Cowen just moments ago. If you missed that, I'm not sure you want to rewind, but the good news is people will still love each other. Equity futures on the S&P positive by 0.6%. On the Nasdaq up by 0.75%. This is your bounce. In the bond market, an unwind at a move yesterday started at about 10 a.m. Eastern time, following a better than expected ISM services print on Monday. Yield to higher still, up by 2 basis points. On a 2-year, got close to 4%. It's backed off since then from earlier this morning. On a 10-year, up by 4 basis points to 383.33. And if you turn to foreign exchange, of course, you want to know where dollar yen is. So here it is, just short of 145, 144.75, up by 0.4%. You've heard that phrase, the carry trade, a lot over the last few days, haven't you? And Danny, we're still trying to work out just how much of that is left to unwind.
Yeah, JP Morgan says we're 50% of the way there, but I think if you ask anybody, they'll have various figures for how much further we have to go. And I think it makes people nervous in this market because, sure, you can have a 10% bounce in the Nikkei, but it does not go anywhere that it needs to go to undo the biggest fall since 1987.
A 10% bounce after a 12% drop. All of that in 24 hours. I thought Jim Carroll at Morgan Stanley was great moments ago. Jim made the point that what we've learned in the last couple of days, we've learned more about positioning than we have about fundamentals. Now, if you agree with that, okay, fine. But what have we learned about market stability, resilience? These moves are so big, so large. And I keep going back to what's happened in Japan. If we can sit here and say this is the largest move since, and then say something like, you know, a year like 1987, which I know is all notable to what's been developing in Japan, particularly in the late 80s. But to sit here and say that we saw something take place in Japan on Monday that GFC couldn't do, that the pandemic couldn't do, that all these events in the last 20 years couldn't engineer ignite, and yet we saw that off the back of one hike at the BOJ, some bad data, and a Federal Reserve that might cut at some point the next month or so.
I think part of the problem is we got really used to a world where the economy was growing and missteps could happen, and you can kind of paper over it because you say things are all right. If you're on the flip side of that now and things are slowing, it gets harder to paper over that. I think the same goes for corporates and the kind of punishment we've seen from corporate earnings. When things are slower and you do something wrong, you are more likely to get punished for it, again, versus another environment where maybe you could look over it.
We've seen some very, very gappy moves in this market, that's for sure. Under surveillance this morning, just a recap of some of the top stories out there at the moment. Vice President Kamala Harris set to announce her running mate ahead of a rally in Philadelphia tonight. It's her first stop in a 7-city tour of battleground states. Reuters reporting the shortlist is down to Pennsylvania Governor Josh Shapiro and Minnesota Governor Tim Walz. Now, I have to say, it'd be pretty awkward if they're in Philadelphia and it's not Shapiro.
Well, that's why everyone immediately came out when she was announcing this is where she's going to have really her kickoff rally going to be in Pennsylvania. Everyone said, well, that means it's going to be Governor Shapiro. And you heard from her campaign saying, don't read too much into the scheduling. They just had to make the schedule. She's hitting up a number of spots this week. But I imagine it'd be pretty awkward for Governor Shapiro if, you know, he gets shrugged off and the big unveiling of her VP is with Governor Walz from Minnesota in his hometown.
I'm so pleased you both picked up on the issue. What's holding this up? Because this felt like it was the clear favorite for about a week. You asked the question about anti-Semitism on the left. Is that what's holding things up? Is it something else? What's behind this decision to stall somewhat?
You have really seen this progressive, this very left progressive base get whipped up into a frenzy, having nicknames like Genocide Josh. I'm sorry, how can you look at that and say there isn't some anti-Semitism playing in here? I think Terry Haynes made a good point that, you know, perhaps it's actually a balancing force to Kamala Harris because you have someone who's very pro-Israel. But does that imply that Harris isn't pro-Israel? Part of the problem comes back to what you've been talking about, John. We kind of don't know where she stands.
Well, she has tried to differentiate herself from Biden when it comes to what is going on in Gaza. The Democrats, though, do not want to give a reason to progressives to have protests on the street outside the DNC in just a few weeks. This goes back to what Steve Eisman said. They do not want to have a repeat of the late 1960s when the convention was failed and there was chaos. But what you see from Shapiro, someone strong on Israel, to Danny's point, does this mean actually Kamala Harris isn't the moderate that some are thinking she is? She's actually left.
We don't know is the answer to that. Is it Kamala Harris that ran in the primaries in the Senate? Is that who we're talking about here? Was she always just a shapeshifter who was trying to get re-elected, get elected, and run for the highest office in the land? Which one is it?
Well, we've already seen some key issues like fracking. Obviously, you cannot win Pennsylvania if you're on the record saying, I will ban fracking. The campaign has come out and said, this is what she said when she's running in the primary. The campaign has come out and said, no one wants to do that. She's not thinking of doing it. So I'm pretty sure anything she said in the past that doesn't bode well for the Electoral College of today, her campaign's going to back away from.
Shapeshifter.
As of now.
Terry Haynes of Pangaea said exactly that a little bit earlier. Let's get to the earnings. Shares of Uber trading higher in the pre-market. The ride-sharing company reporting better than expected gross bookings in the second quarter. Earnings continuing throughout the week with Disney and Warner Brothers Discovery due out tomorrow. The good news, I guess, is that we have got some decent earnings.
Yeah, we certainly do. And some of it, I mean, kind of bodes well for the consumer. If people are willing, you know, to forego public transportation and take an Uber instead. One of the things in their earnings was that their ad business is doing really well. They're doing in-app advertising now, exceeded a run rate of $1 billion last quarter. I'm sorry, are we going to have ads in everything? Netflix is now an ad business. Uber is now an ad business. It's like everyone has kind of like given up on everything else and just saying, and we're going to show you a few ads and make money from that.
Have you noticed how many political ads we're starting to get as well? Going into November. Just getting a headline here just on the politics. So this is what we know so far from AP. Anne-Marie, the Vice President has decided on a running mate. Have we got any detail on who that running mate actually is?
Doesn't look like we have the name, but that she's actually decided. I wonder if their reporting is now, or she really did make the decision this morning, because we actually saw yesterday, a lot of people on Twitter were talking about all of these massive SUVs leaving the governor mansion in Minnesota because he was going to a campaign event. One thing to watch out for, the second someone is tapped as a VP candidate, before the world knows, the Secret Service will know, and they will see a heightened amount of security around that individual.
So look out for that. That's the headline just dropping moments ago. According to AP, the Vice President has decided on a running mate. We just don't have the important detail for you, which is who that running mate actually is. We'll keep an update on that for you when we get one. We'll bring it to you. Let's get to this news right here from the San Francisco Fed President Mary Daly, acknowledging the labor market is slowing, but saying, quote, "We look at the totality of the information before we act." The focus turning to Thursday's jobless claims data. To look ahead to that, Christina Campmany of Invesco. Christina, it's good to see you. Wild couple of days.
It's been a crazy few.
Super wild. Have we unwound this long dollar yen, short JGPs, long Nikkei story yet? Have we done all of that?
I don't know if we've fully cleared through it, but I think broadly across all of these markets, and we've seen like this gutting of positions in equities, in credit, in currencies, has been a positioning story. And I think to Jim's point earlier, Neil, it's not the fundamentals of just Friday's payroll report. Yes, we've seen some slowing. We know we're going to see some slowing, but this is much more, I think, about positioning. I think we're cleaner. Is it the end? I'm not sure, but...
Let's go with that word, cleaner. If we are cleaner, where do you want to step into? What do you like based on these moves following the storm of the last couple of days?
Yeah. So we've kind of been in this camp that we don't think long end duration across most developed markets has offered value. And I still think that case holds, that we don't want to be involved there, and the extreme of this rally has been too much. I mean, certainly we were a bit on the wrong side of that, given how much we've run, but you think about the front end, to hold twos here, it's negative 11 basis point carry in 1 month. I think a lot of duration has been purchased at bad levels. So then we go to, where do we want to own? We think there's value in inflation bonds. We think there's value in break-evens that have really lagged in this move. And I think it can play in both cases if, in fact, you do have much weaker growth and a recession, which is not what we're calling for. We think the Australian bond market offers some value. And I think broadly, we still think that the dollar should be weaker and that there's some value in currencies.
Well, to this point, if there are value in other currencies, if the yen isn't your carry trade now because of all this, what is? Realistically, can anything take its status as the funding currency?
Look, I think the popular funding currencies out there were the yen trade and CNH in China. And I think Japan as a whole, is it just the one hike from the BOJ or the second hike that's doing it in this 15 basis points? No, I think it's the totality of the positioning with the Nikkei and short JGBs. And you bring back to we've had 1987 type moves in the Nikkei and whatnot, but is part of it we've gone in the last 10 years, the US has had full cycles, and only now in the last 6 months has the BOJ hiked 25 basis points when the Fed has had multiple cycles. So you finally have had this engagement into the Japanese market, shorting rates, finally getting long the Nikkei. I think that explains part of the extremity of the moves.
And to your point, a 25 basis point hike, if we start to see a real cycle, I mean, already there are people calling for the BOJ made a mistake, they shouldn't have hiked whatever. But if this is a real cycle starting, is there even more offsides that we have yet to discover for something we haven't had for a long time?
Yeah, I still think there's value to owning the yen here, and I think because it's been so unfavored because of the carry status of it, and you can make up for that carry elsewhere. And we think, again, like when we have a focus in emerging markets, and when we look at a lot of the fundamentals in these emerging markets, there's still value. You have things like MXN that has been blown out in large part because of these cross MEX yen positions, and so things have overshot. Are people falling over themselves to get back into these carry currencies? I don't think yet, but do I think 6 weeks out we have stability and those are still okay places to own? I think so.
You said earlier that potentially we haven't seen the full unwinding of what's going on with the dollar yen, the carry trade. When will we know?
I don't think you know until it's over, right? Like, they're emotional markets, and I think you have to say, where are the levels? What can we do? Again, same thing if you look at equities. When is it over? When have you had enough? Is this extreme? We've had a lot of, in the last 3 sessions, these calling for intermeeting cuts, and is the world ending, and all of these things. Equities, as of yesterday's close, we're still broadly up 10% on the year. So, like, I'm not an equity expert by any means, but, like, seems you're still having a reasonable performance year to date.
I'd love to get to your world and talk about credit just briefly and have a chat about what's been happening with credit spreads. High yield spreads were super tight. A few weeks ago, sub 300, now approaching 4. Danny was talking about some of the issuers that have had to step to the side, particularly in the last 24 hours. How do you see things developing just on the technical side of things? How many suppliers are going to come? How many issuers will come into this market to issue supply in the next few days? What's that going to look like? Are they going to step in and try and lock in some of these yields now before things start to gap even wider?
So I think, of course, with the volatility of the market, you'll have a quieting of supply and people waiting for a bit of calm. And today, knock on wood, it seems like we have a little bit more calm, certainly, than the last 2 days. Again, my particular focus isn't credit, but when we look broadly and when we think about it, the health of the overall high yield market, when we look at companies and names, is a much healthier basket post-COVID, post all of the refinancing that went on in that period. So you had high yield that was exceptionally tight and has repriced a bit. But again, I feel like there's a lot of this panic about people talking about things falling out of bed. In reality, CDX high yield is still trading at 104. In December, we were trading at a 99 handle, 98 handle. So again, I think when we put into context where we are, I think there's a lot more panic in the market than is warranted, probably.
It's levels versus change. The change has been impressive. The levels are still pretty decent, I guess. Christina, thank you. It's good to see you.
Yeah,
Christina Campbell of Invesco. It's always the change that gets the headlines, right? You know, and we've seen some vicious change in the last few days.
Yeah, and a vicious change is enough, again, to like spook suppliers to come off the sidelines. It's not enough to say, again, to your point, that the world is falling in, but it is enough to do some damage. And we still need to grapple with what the lasting damage of that might be.
The world is not ending. And as Oliver Chen said, people will still love each other. So it's like therapy this morning. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. Secretary of State Antony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. Blinken says the U.S. and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Tehran has warned it will respond after blaming Israel for killing a top Hamas leader last month in the Iranian capital. Tropical storm Debbie threatens days of rains and floods along the East Coast after slamming into Florida as a hurricane yesterday. The storm left more than 300,000 people in Florida and Georgia without power, according to poweroutage.us. Governors in both those states and South Carolina have all declared emergencies, and President Joe Biden has approved federal help. And the Paris Olympics continue today with 2 elimination games for Team USA. The women's soccer team takes on Germany in their semifinal, while the men's basketball team enters the knockout stage against Brazil. There's also plenty of action in track and field with St. Lucia's Julian Alfred looking to follow up her win in the 100-meter final with gold in the 200-meter event. The U.S. is tied with China atop the medal table with 21 golds, while the U.S. has the most overall medals with 79. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, setting you up for the day ahead, plus the argument for a 50 basis point rate cut in September with JP Morgan's Michael Feroli. That conversation up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Three minutes away from the opening bell. The scores look like this. Equity futures positive by 0.3%. Got to keep an eye on this. This move's fading just a little bit. Yields are higher by 3 or 4 basis points. The 10-year 3.8258. The move fading a little bit in dollar yen as well. 144.54. We're backing away from 145. It's still a weaker Japanese yen. It's nothing like the strength we've seen recently in that currency, but we're starting to unwind some of the movement this morning. So the move's fading as we get closer into the cash open. Counting it down to the opening bell, looking ahead to all of this, your trading diary set up as follows. Vice President Kamala Harris speaking at a rally in Philadelphia with her yet-to-be-named running mate at 5:30 p.m. Eastern Time. Tomorrow, earnings from Disney and Warner Brothers Discovery. Thursday, another round of jobless claims. Plus, we'll hear from Richmond Fed President Tom Barkin. All of that to look ahead to, plus Michael Feroli of JP Morgan saying he thinks the Fed will cut by 50 basis points at both the September and November meetings, followed by 25 basis point cuts at every meeting thereafter. Feroli adding, from a risk management perspective, we think there's a strong case to act before September 18th. Michael Feroli joins us now for more. Mike, wonderful to catch up with you, sir. It's been far, far too long. Let's get into that call. Not the 50. I want to talk about the bit before that. From a risk management perspective, we think there's a strong case to act before September 18th. Michael, just explain why.
So I think even as of last Thursday, the Fed was probably behind the curve. I think obviously the news on Friday further adds to that. Now, I don't think they will cut intermeeting unless we get, I guess it's possible if we get a bad jobs report in early September. But right now, I think, if risks are close to balance on inflation and employment, they should be closer to neutral. So that would be at least 100 basis points lower from here. So I don't see why you would want to take your time getting back to a place where you can better address both risks to inflation or to employment should those risks materialize.
Michael, there's been lots of conversation about this, about should they do an emergency Fed cut, should they go 50, should they go 50 again? As I know those two 50s are your point that John laid out. What should they be doing with QT and all that?
QT, I think that's kind of on a separate track right now, and I think the decisions on QT will be mostly determined by liquidity conditions in the interbank market. So I see that discussion occurring mostly on a separate track from where we are now.
Okay, fair enough. Let me give you kind of the devil's advocate to why you shouldn't go 50, and this comes courtesy of Apollo's Torsten Slok, who's been talking about this for some time, that just before Friday, the narrative was that this is a soft landing, that the totality of the data showed a GDP growth at 2.8%. You still have strong showings of people up at airports, retail sales have been strong, and the labor market is not slowing to a point where it looks like it might become nonlinear. Therefore, there is no rush to cut, and no rush to cut in a big way. Why is he wrong?
Well, look, I think policy is restrictive right now, and restrictive policy is appropriate when inflation risks are abound. And right now, I think inflation risks are coming down and employment risks are rising. So I think you want to get back on sides and again, taking your time to get there, I don't think is optimal given what we're seeing, again, in both inflation and employment.
Michael, just to be clear here, this call then is independent of whatever we get from the August jobs report.
No, I do think August jobs are going to matter for this. I think claims are going to matter. But I think you would have to have a pretty nice turnaround in almost all the activity data we see to make the case for going slow.
Mike, appreciate the update. 50 basis point call for September. Thank you, sir. Michael Frody there of JP Morgan. Just getting some breaking news. Anne-Marie, over to you.
Well, CNN's reporting that Minnesota Governor Tim Walz is the one that has been tapped for Kamala Harris to be her running mate come November 5th. This is the governor of Minnesota. It's an individual, Jonathan, that really has a really interesting background. Former National Guard officer, a former congressman, and a former teacher, and of course, a former governor. And he's been an effective communicator. He was the one that first said that Trump and J.D. Vance are, quote, weird. And the Kamala Harris campaign really jumped on this. The Gen Z really jumped on this. So he's the individual that she has chosen to be her running mate in November, someone that she thinks can potentially bring in moderate independent voters. But this was someone that the progressives wanted because they didn't want to see Governor Shapiro on that ticket.
So a couple of things. This is CNN reporting, not seen it confirmed by the campaign just as yet, but this is the latest from CNN. When we get an update from the campaign, we'll share it with you. Let's just separate two things. I want to talk about the decision that's been made here, if this is the decision, between going with him versus going with Governor Shapiro, and then talk about how this is an advantage for them as you start to look at the Electoral College and the map going into November. Why this guy? Why not Governor Shapiro?
So it looks like for someone like Minnesota Governor Walz, he is seen as someone who can effectively communicate to the rural America. He has this rural American charm. A few weeks ago, there was a video that really went viral of him wearing a military-style baseball cap, ammo cap, and a Springsteen T-shirt, but didn't look like he was trying to placate to everyday Americans. Looked like actually this is who he is. He speaks normal to America. So this is someone that I think she thinks can help with the Rust Belt, even though Minnesota is blue. Governor Shapiro would have been a pure play for Pennsylvania. And this evening, she's also kicking off her rally in Pennsylvania, but it's going to be with this man who, it's a 2.5-hour flight from Minnesota to Pennsylvania. He's going to be flying over and joining her, not Governor Shapiro.
Yeah, potentially awkward. And I can't but wonder, Anne-Marie, you know, when we knew that Trump chose J.D. Vance, we had all this stuff we could say, like we know his policy, we know how it might affect Trump. Do we know that with Walz, what his views might be that impact Kamala Harris's policy?
Well, a lot of people say he's actually governed more to the left, even though he is able to win, like when he was in Congress, he was able to win a very red district. He's governed to the left. But a lot of things he's going to talk about is things like all children in Minnesota going to these public schools, having breakfast. Things like this, everyday concerns of Americans, are things that he's worked on in Minnesota and that he's going to want to talk about on this ticket.
So this is all signal. We need to start talking about substance and policy. We need to get away from just campaign rallies and talk about sitting down and actually communicating what your views are on key, important subjects for this economy, for foreign policy, and a whole range of issues. We're going to start to get some of that from the campaign in the coming weeks.
Well, we hope. There's no longer an excuse for the campaign to not put Kamala Harris in that setting. So, of course, this week she's going to go on this blitz. These are rallies. She's going to be talking to her own voters, not across from a journalist that are going to try to nail her down on what actually are your policies, because we have seen her shift and flip a number of times. So they have this week a blitz across the United States on key states. Then it's going to be the DNC convention. After that, it's really time for her to start to hammer out and discuss where she sits on these policies.
And we'll see if we can get some debates in the mix in the month of September as well. We'll see.
TBD.
Just to confirm, this news coming from CNN, Minnesota Governor Tim Walz tapped as Kamala Harris's running mate. That coming out of CNN today, not from the campaign just as yet. If we get confirmation from the campaign, we shall bring it to you. That's the latest on the political front. I want to talk about the markets going into the opening bell. If we can just reset and get the market board up and check out equity futures, because last time we looked at this just moments ago, the move was fading, and it has faded just a touch, Danny. We're up by about 1/3 of 1% on the S&P. Looking at bond yields, they were higher, just up by 3 now to 382. And likewise, the move in foreign exchange, dollar-yen, was close to 145 when this program started, now back down to about 144.60.
Well, you'd hope that maybe if basically the big sell-off was over, you'd have more people coming in force. And I think this gets to some of the fears out there that perhaps the whole thing hasn't unwound, the fears of not really understanding of how you even measure how these types of things unwind. So the bounce isn't a huge one, but has something shifted in the sentiment now? Has something shifted that you are more likely to sell, that you are more likely to buy bonds, and what you need is convincing from every data point that what isn't what you should be doing, which is, what we got yesterday with the ISM and the bond market.
There's a bit of a vacuum here, isn't there? It's a bit of a dry patch for data for Fed speak. You won't get much data through the next couple of days. The next big one is jobless claims on Thursday, and not much Fed speak is scheduled either between now and the next week or so. CPI, of course, about a week away. Coming up tomorrow, here's your lineup. Nouria Rabini of Rabini Macro Associates, Michael Dada of Roth MKM, Mohammed Al-Erin of Queen's College, Cambridge, and the Disney CFO, Hugh Johnson. That's quite a lineup for tomorrow morning. From New York City, good morning. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Waiting for markets to bounce back a little after yesterday's big rout, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is off today. Bloomberg Open Interest starts right now.
Coming up, a crucial moment for the Kamala Harris campaign. CNN reports that she has tapped Minnesota Governor Tim Walz as her running mate. And a tepid turnaround. Global stocks stabilized for now as some investors brace for more volatility after Monday's massive sell-off. Meanwhile, earnings abound, from Caterpillar's sales miss to Lucid's $1.5 billion lifeline. We'll take stock of the latest corporate results. Let's take a look now at where markets are trading. As you can see, we do have a little bit of a bounce back, but it is fairly tepid, especially compared to what we saw overnight in Japan, with the Nikkei up 10% after the big drop going into Monday's trade. In terms of the 10-year yield right now, it is rising, so investors are selling those treasuries that they were clamoring to buy yesterday morning. Sonali?
I want to take a look at some of these stocks this morning, Matt, because of course we have a lot of earnings, and Caterpillar says annual profits will be higher than expected. And in the rideshare industry, of course, we also flip up the board. We see Lucid and Uber roaring after reporting earnings. These are some of the biggest moves. So Lucid up more than 9%, Uber up more than 8.8%. Remember, pre-market, they have also said that they're not seeing signs of weakness in the consumer here. And Palantir just roaring, up 11% pre-market. Matt, remember, they're also saying that they're boosting their forecast. We also today, in the next hour, have an interview with the Lucid CEO, Peter Rawlinson, at 10:30 a.m. Eastern. You're not going to want to miss that.
Yeah, absolutely looking forward to asking him what he plans to do with this additional $1.5 billion injection that Lucid is getting from Saudi Arabia. Now, let's get back to the markets here. Investors breathing a sigh of relief to some extent this morning, but some market veterans warn that turnaround Tuesdays don't always last. Many traders are braced for another big sell-off, with black swan hedging to ensure their portfolios surging. And JP Morgan warns that the carry trade unwind has more room to run. Meanwhile, Citi strategists recommend waiting before buying the dip, while Goldman Sachs says that buying the S&P 500 after a decline of 5% has typically been profitable in the past 4 decades. Joining us now to share her perspective is Gargi Chaudhuri, BlackRock's Chief Investment and Portfolio Strategist for the Americas. Gargi, great to have you on the program. Thanks so much for joining us on set. So yesterday was nuts, right? But it seemed to calm down a little bit, even amid the big losses at the end of the session. Today we saw a huge turnaround in Japan overnight, but we're not really getting that in futures. Do you think investors should be buying the dip?
So good morning. Thank you for having me. I think yesterday was what one would expect in a thinly traded August Monday, when you have some slightly weaker than expected data, as well as massive moves overnight in Japan, as well as unwind of the yen carry trade that you talked about, all of that influencing sentiment. But what I think this points to is how much investors should focus on the fundamentals. Between July 1st, call it, to yesterday, have fundamentals meaningfully shifted? One can say that perhaps at the margin, the job numbers are a little bit concerning. They're slowing down, they're moderating. But are we really thinking about a recession? And my answer would be no. So where you buy equities and where you buy bonds is going to be very crucial. On the way down, investors sell indiscriminately because you just want to get out of your positions. On the way up, you buy with surgical precision. And that is where we're telling investors, focus on quality, focus on companies with strong balance sheets, focus on companies with profitability, and in the bond market, focus on the belly of the curve.
There are a lot of investors out there still very nervous about buying into this dip. And if you take a look at what JP Morgan was saying, this idea that the carry trade is only half complete, how much more deleveraging has to happen before this market feels safer for an entry point?
I think a couple of things have to happen. Obviously, the impact of the carry trade and how it can be felt in different corners of the market will be important. But alongside that, I think we also have to wrap our heads around what the data is telling us. Obviously, we saw the market turn around yesterday after the ISM services data. I think we're going to keep a sharp eye on what the Fed speakers are saying. We heard from Mary Daly, who again pushed back on the narrative of recession. I think all of that is super important. So yes, the yen carry trade will be technical, but the fundamentals, I think, is what's going to matter. And what we're looking for, of course, is the next payroll print, but also the couple of CPI data. We're looking at the initial jobless claims, as that's obviously something that's a lot more timely than many other data points.
Right.
And we're looking at all of that to determine, is this just an expected moderation from the COVID-fueled levels, or is there something more? As of now, I don't think there's any kind of concern around recessionary fears, which is why, as we don't have a recession, we're about to have the first rate cut in September. Those are some great levels to be buying profitable, high-quality companies.
All right, Gargi, hang tight because we got to talk about this breaking news in politics right now. Kamala Harris has reportedly tapped Minnesota Governor Tim Walz as her running mate. This, according to CNN. Bloomberg's Anne-Marie Jordan joins us now at the desk. And Anne-Marie, this is interesting because she had a choice between, a hawk on Israel and a fairly conservative Democrat in Josh Shapiro in Philadelphia, and a very left-leaning liberal governor out of Minnesota, and she went left.
She went left, and many would say actually she is left, although we have seen her renege on some policy proposals she talked about when she was running in 2019 to get the primary, to be on the Democratic primary. Things like fracking, they've come out now and said actually she doesn't want to ban fracking. So she went with Governor Walz of Minnesota, according to CNN at the moment. He's in Minnesota. This leans Democratic. This is a blue state, but it's very close to Wisconsin. It's very close to Michigan. I guess the hope here is that he can still be that voice for the Rust Belt. And he can be that folksy, rural, charming guy on the ticket who, frankly, just talks to the American people. When you see him in interviews, if you see him interact with people in Minnesota, he talks in a normal manner. He is able to speak to white men. He is able to speak to individuals who potentially are not college educated. So I think that's where they're going with him in terms of trying to balance out the ticket. We do know that they wanted to get a white male on the ticket, so he's going to be that one. He's in Minnesota, she's from California. I think with Shapiro would have been another coast.
That's very much Soundgarden. It's very much feeling Minnesota.
Yeah, no, but Shapiro would have been another individual. It would have been East Coast and West Coast. I think one thing for sure, though, under the surface, what progressives were really pushing against Shapiro because of his stance on Israel, how he dealt with pro-Palestinian protesters, and it looks like she went with the other individual potentially because of this.
What's the role of some of these other constituents here? What's the role of Congress here? I'm looking at this Axios headline calling it quiet diplomacy in Congress when it comes to Tim Walz. There's also the unions. How might some of those cross currents play into their full ticket?
Well, I think when they're looking at this ticket, they wanted someone who could be that person. Probably she was the one that made the final decision on this, who she thinks makes up for what she lacks. Now, we'll see what that means tonight, what they're at the rally, when they're talking to individuals in the Midwest. And I think for the Kamala ticket right now, they probably agree, though, on a lot when it comes to policy. You mentioned the fact that he is a progressive. Things like tuition-free meals at state universities he was for, enshrining abortion rights in Minnesota, providing protections for gender-affirming health care. He is pretty to the left. So they're both going to have to move to the center if they want to win those independents.
He does want to provide protection for school-age children to get things like puberty blockers, and this is what you mean by gender-affirming.
Yes, providing those protections.
Interesting. So, but they're both to the left. It's interesting to me that she didn't choose somebody in you know, a little bit more the vein of Mark Kelly, who is the son of police officers, who was an astronaut and a fighter pilot, and much more moderate in terms of, you know, his stance on the border, for example. This ticket is really not going toward the center as I thought it would. Does that surprise you?
Not really, because we've seen how much of the outpouring of support Governor Walz has had from progressives. Also, how well he's done in terms of communication. He has really been the one that termed this whole idea that Republicans are weird. His words, not mine. He said Trump, Vance are, quote, they're just weird. Kamala Harris, Gen Z, TikTok, this has picked up. So he's already been an effective communicator for her. He's an effective individual when it comes to bringing in donations. Also, similar in the vein of Kelly, who's an astronaut, an event, he actually was a National Guard officer, he was a congressman, and he was a teacher. So he has a really long list of other professions and other hats he used to wear. And I think that's why they think he could be an effective communicator in middle of America.
I really want to get this in here, too, because so much of the reason people thought she was going to choose Shapiro was to win Pennsylvania. Now that she's not, and according to the AP now as well, also saying Tim Walz has been picked, does this mean that Pennsylvania becomes more or less difficult to win?
You know, that remains to be seen. People will say, does it actually matter who the VP is? It matters who's on top.
People always say no.
Yes, and it matters who's on top of the ticket. But when you're dealing with very small groups of people, and if this election is going to be won or lost in Pennsylvania, which many are claiming it is, then potentially Shapiro could have helped, because he has great numbers in Pennsylvania and he's very well liked there. What might be a little bit awkward this evening is that Governor Walz will be flying over to Pennsylvania for the start of her campaign. She's going to announce him side by side at this rally, and is going to be in Shapiro's backyard.
Well, you know, there's the rest of the cabinet, too, right? Anne-Marie, we thank you so very much. That is Bloomberg's Anne-Marie Bordern. Now let's get a look at the stocks moving ahead of the opening bell. Tons of earnings out there. Abigail Doolittle is here to join us.
Tons of earnings indeed, Sonali. And after yesterday's sell-off, we have lots of stocks in the green, including Palantir. The data company put up a great quarter. They beat adjusted earnings. Revenue grew by 27%. They also beat the revenue estimate. This as they boosted on strong AI demand. The company also really emphasizing the importance to them of the U.S. military. Let's take a look at some other earnings movers here, because the shares of Uber should be trading higher. Yes, indeed, up nearly 9%. They put up a nice beat and boost as well. 20% adjusted profit beat. Sales were better by 1%. The third quarter bookings demand is strong, and the rideshare demand is strong. Yum Brands, on the other hand, down just slightly, down 0.3%. It was a mixed quarter. They beat profits slightly. They missed sales just a little bit. Taco Bell was strong, but Pizza Hut and KFC, not so much. And then finally, let's check in on the biggest movers, big tech. We have mainly a rebound. NVIDIA up 2.5%. Tesla and Amazon higher, but you can see Amazon up just ever so slightly. And then, Matt, take a look at the one stock that is not like the others. That, of course, is Apple, right now down 1.3% as the biggest weighting to the S&P 500 and the NASDAQ. Keep an eye on this one. It's very tenuous technically. If this decline continues, it, from a sentiment standpoint, could pull down the rest of the complex. We'll be watching this closely.
All right, Abigail, thanks very much. Abigail Doolittle talking about some of the stocks moving ahead of the open. Still got about 18 minutes to go. Coming up, Caterpillar shares are up as the world's largest maker of earth-moving equipment says it'll earn more money than expected this year. We'll dig into those results next. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? I mean, like, what's that about?
we're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. Vice President Kamala Harris has tapped Minnesota Governor Tim Walz as her running mate. This is according to CNN and AP. In choosing Walz, she's turning to a Midwestern governor, military veteran, and union supporter who helped enact an ambitious Democratic agenda for his state, an ambitious progressive Democratic agenda for his state, including sweeping protections for abortion rights and generous aid to families, really going to the left with this choice. Jared Kushner wants to turn Balkan war relics into luxury hotels for the wealthy. Albania and Serbia are championing the investments, but critics fear it's to curry favor with the Trump family. And San Francisco Fed President Mary Daly says the labor market is showing signs of softening and officials should begin cutting interest rates in coming quarters. How much the Fed will have to cut and when, she said, will, quote, depend a lot on the information incoming, on the data, of course, as the Fed always says. Shonali?
And I want to check in on shares of Caterpillar here. They have been volatile pre-market in the sense that they were up. Now they are certainly down. They're down more than 1.2%. And the stock, remember, is seen as a bellwether for industrial activity. Sales were below expectations in the second quarter. Profit beat. We're going to discuss more with Bloomberg Intelligence analyst Chris Ciolino. And you think about just what they said. Initially, that idea that profitability was getting a little better was a bright spot. But of course, given what a bellwether they are, not every segment had improved here. Where are you the most concerned?
Yeah, I actually think there's a lot of positives to take away from the report. Underlying margins were better than expected across all units, with particular strength in the energy and transportation unit. Yes, they took down the sales guide, but I actually think that's a positive here. The reduction is really driven by a decrease in dealer inventories that they expect over the balance of the year. There's a big concern out there that Caterpillar is building too much inventory. So I think this slight tweak down on the top line is actually a positive, but they also raised their margin outlook for the year and now expect earnings to be stronger than they anticipated heading into the quarter.
All right. Chris, thanks so much for joining us on Caterpillar. Bloomberg Intelligence analyst Chris Ciolino. You can look at his research on the Bloomberg terminals. Type BIGO. We're back now with Gargi Sharduri, Chief Investment and Portfolio Strategist for the Americas at BlackRock. And Gargi, what do you think about earnings season so far? I mean, it's striking to me that if you took out the Magnificent Seven, the last 6 quarters have seen contractions in earnings, really an earnings recession. Now we're expecting that to broaden out and turn around. Is that coming to fruition?
It is a little bit, and I think that's what's very encouraging about this market. The fact that we are, especially this earnings season, seeing earnings growth come from the other sectors. We're seeing that in healthcare. We're seeing that a little bit in financials. And I think all of that is a really good sign for the broader markets, that it's not just coming from the same 5 or 7 stocks. I'll also say that under the surface, we are seeing a little bit of concern around consumers. Obviously, that's coming up a lot, and I think that'll be something that we discuss a lot more around the health of the consumer. And we're seeing that in some of the earnings transcripts around especially the bottom quintile or the bottom percentile of the income spectrum is beginning to show a little bit of weakness. Again, where that can go will determine how some of these companies do, but which is why I think focusing on profitability and focusing on companies with strong balance sheets and strong profit margins is going to remain really important.
I need to also give you a bit of a, let's call it a victory lap here, for a very smart call you made about 2 weeks ago. At the beginning of July, you saw this tremendous rally in small and mid-cap stocks, and you look now, that entire rally has been wiped out. You were skeptical about this from the beginning. What is the big cautionary tale here?
Yeah, so the reason that small caps did as well as they did was right after that July CPI print, markets were pricing in cuts, and that was what was one of the biggest catalysts. And we felt that, of course, you needed to see those real rates move lower, but at the same time, you also needed to expect earnings growth to come forward. You needed to see that, which we weren't seeing. More importantly, I think we needed to recognize that small caps will only work in a period where interest rates are going down, but growth is remaining steady or moving higher. As we have since learned, again, no recession, but growth certainly isn't moving higher. So what has been more interesting to me is the move away from cyclicals to defensives, that especially as we go into the next couple of months into election season, I think there will be more investors that are gravitating towards some defense. Buffered strategies are a great way to play that. You can remain in the markets and protect your downside. Minimum volatility strategies is another way, and then utilities is a great way for investors that are looking for a little bit of defensiveness.
What if we get, we're going to talk to Tony Dwyer a little bit later, and he wants to see the Fed cut deeply. To counter, the massive hikes that we had when they were trying to thwart inflation, 75 basis points, 4 times in a row. Huge, right?
Yeah.
So, but if we get 50 basis point cuts, if we get, Connor Sen yesterday was writing, he wants to see 100 basis points in this year, sort of front loaded. Do you then go back into the Russell 2000?
I think it will depend on why the Fed is cutting. So if they're cutting because of a growth shock, what we were pricing in yesterday as we walked into work, I don't think that's going to be a good time for Russell 2000.
But if, the Atlanta Fed says 2.5% growth in Q3.
If indeed we see strong growth, so 2.5%, exactly what we saw in the second quarter following into third and fourth quarter, if we see that strong growth as well as the Fed cutting, as well as, importantly, the Fed cuts moving its way through the economy such that small cap companies are able to allow themselves to have access to banking and access to the credit markets. I think all of that, the transmission mechanism matters. If we see that, then absolutely. For now, IWM, which is of course our Russell 2000 ETF, has seen a lot of activity, as you know, Matt, in the option space, call options, renters of the space, which we think is fabulous to play for short-term moves in the market, but we haven't really, at this juncture, we still think quality, and if you're looking for a little bit of protection, then buffered is the way to go.
What have clients been asking you over the last 24 hours? How much of an inclination is there to hide in cash right now?
Yeah, that's a great question. So we've obviously been speaking to a lot of clients over the last 24 hours, and the first question that comes up is, what signals are you looking for to make sure that this isn't a recession, right? So that's top of mind for investors. And number two, they're asking around, should I move to cash? And if not, why not? Because cash is yielding us, over 5%. And there the conversation has to be around explaining to investors that, number one, if you move to cash at this juncture, and depending on how long you can hold it, you might not get losses. You might not get that entire 5% that you see on your screen. And number two, bonds have finally brought back that negative correlation. The normalization of correlations between equities and bonds are back. So bonds are giving you and can give you more of that protection. And finally, I would say that dips are very common in markets.
You mentioned the buffered product, and I have to ask, how popular was that before this? I'm sure investors that got into those are happy that they had them.
Yeah.
And have you seen that popularity increase over the last 48 hours?
Even over the last 24 hours in terms of how our MaxJ buffered ETF, which is the max buffer ETF, has traded a lot of volume, 2 times average daily volume. That is just an indication of investors sort of looking, as well as a lot of clients asking questions and flows into that space. I think given this rise in vol, there's still a 10% upside capture with minimum downside capture. You don't get that in these markets. So a lot of questions. We hope that many more investors will take this opportunity to not move to cash, but try to preserve their downside.
I don't think everyone knows enough about these products, which is why I think they're so interesting. Obviously,
well, that's why you should watch Open Interest.
I'm kind of an ETF, lover myself.
Gargi,
yeah.
we have to leave you there. We could go forever. That is Gargi Chaudhary of BlackRock. Stick with us. We're going to talk a lot more about these markets ahead. Of course, we're getting a little bit of a bid back in the market this morning, but not by much. It certainly doesn't bring you back to where we were just last week. Stick with us. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, we have 4 minutes to go until the opening bell. This is Bloomberg Open Interest. Quick check on what's going on in futures. You can see that we're looking at gains, a little bit of a bounce back after the big drops that we had yesterday. We are going to talk more on this program about the VP pick. Kamala Harris has chosen Tim Walz, the governor of Minnesota, to be her vice president as the campaign shifts to the left to counter Donald Trump. They are ahead now in the polls in terms of Real Clear Politics polls and in terms of the betting markets as well, and predicted. We'll talk about that later in the program. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Moments away from the start of trading on what could be a turnaround Tuesday. This is Bloomberg Open Interest. I'm Matt Miller. Taking a look at what's going on in futures, we do see slight gains. Nothing like what you saw in Japan overnight. I was shocked when I saw the Nikkei soaring 10% at the open in Japan, but we don't see that here in the U.S. We did have green arrows in terms of stocks, and you did have yields on the 10-year coming up as investors sell those bonds that they were clamoring for, at least at the beginning of the trade yesterday. There you hear the opening bell on the New York Stock Exchange and on the NASDAQ. Let's take a look as trades start to come in at the major averages and where they are panning out. You see the S&P 500 right now at 5203, so up 1/3 of 1%, adding about 20 points. The NASDAQ 100 adding about 80 points, also up about 1/3, a little more, almost 0.5% right now. And the Russell 2000, those small caps coming up the least, but nonetheless making some gains, a little bit more than 1/10 of 1%. So we do see a little bit of a bounce back, but it's nothing like the kind of bounce back that we saw in the Asian trade. And the question is, how long will this hold? Because the concerns still abound. Lucid, for example, right now soaring 13%. That's not because the earnings report was so great, because they've gotten through all their production woes, because they've convinced Americans to buy electric vehicles for very high costs again. That's because the Saudis have injected another $1.5 billion, giving them a lifeline to get through to SUV production. You can see Uber shares also up more than 6%, and actually earnings have been fairly good right now. Palantir, if you looked at, was very positive. Caterpillar earnings in terms of the profits were great, but the sales not so much, and those shares have turned around. Sonali has a look at that right now. Sonali?
Yeah, if you take a look at it, to your point here, the profit did beat estimates, but remember, annual profit was higher than previously expected, but sales are going to be lower than expected. We had shares earlier today in the green, now flipping sentiment here closer down to 1%. Flip up the board, watching Palantir and Lumen. Persistent AI demand leading to both stocks rising today and rising by quite the margin. Lumen up more than 43% and Palantir up almost 12% this morning. Let's take a closer look at this bounce back in technology with Bloomberg's Abigail Doolittle.
Yeah, there is a bit of a bounce back, Sonali. Yesterday, of course, at the lows, that NASDAQ 100 down more than 6%, closing down about 3%. Let's take a look at some of the movers. So NVIDIA at the lows yesterday down 15%. That would have been the worst day since 2020, closing down 6%. A bad day. This stock in a bear market, trying to make a rebound today, back above 100. Technically, though, the stock does look vulnerable. Microsoft higher, Meta higher. But take a look at Apple. We were highlighting this one as a key stock to watch yesterday. It does very much look like it's going to drop below 200, go deeply back down into a range, down 1.9%. Now, an interesting tell on the tech volatility. So what I'm saying here is Apple suggests more volatility to the downside overall could be ahead for tech. The VIX for the NASDAQ 100 may too suggest suggest that. You can see this massive spike up yesterday at the highs at a 39, much lower than the VIX itself, but the VIX has been elevated above 20. Some options investors there really seeing what could be ahead for big tech. In fact, let's take a look at the NASDAQ 100 chart. We love to look at individual stocks, but at index level, the NASDAQ 100 yesterday going below that 200-day moving average. The RSI not quite oversold. If we compare this to 2022, you can see there was an area for several weeks, even months, before investors could really figure out what was going on. I suspect, Matt, that is ahead. Stay tuned for some more volatility in big tech.
Yeah, absolutely. Abigail, thanks very much. Abigail Doolittle looking at the charts for us. Let's talk more about the markets and the Fed with Tony Dwyer, market strategist at Canaccord Genuity. Tony, great to have you on the program. Thanks so much for joining us. Reading in your notes, I was reminded at the intensity with which the Fed raised rates. If you take a look at the five-year chart of the Fed funds rate, you can see they started with a little 25 basis point, but then went 50, 75, 75, 75, 75, and then 50 again. So huge leaps there. Do you think we're going to see the same kind of intensity on the way down?
It's funny, Matt, we look at what the Fed funds future, thank you for having me, the Fed funds futures are telling us, and it's so silly because if you look back in the beginning of the rate hike cycle, when they started raising rates in 2022, they had only assumed that the market had assumed that the peak rate would be 75 basis points. They ended up doing 4 75 basis point hikes in a row, and somehow we think that a 25 basis point cut, yes, of course it's messaging, but with the 10-year bond yield already down, given the obvious inversion, clearly the market has already discounted a pretty significant rate cut cycle, yet we're still talking about whether it's going to be 25 or 50 when it probably needs to be a lot more.
Well, to that end as well, if you don't see a lot more, Tony, what does that mean to the read-through of the market? Because you saw that sell-off really start to accelerate Friday after those jobless claims, and you have to imagine if rates don't come down fast enough, how that looks a year from now. Where are you seeing the pain?
It keeps us in this zombie-like environment. We haven't seen this broad market surge because we're still in the debate of whether it's a soft landing or it's going to be a recession. We still have the inversion of the yield curve. So all those factors that have kept us there without a more aggressive rate cut cycle keeps us in this I don't know what to do camp. And when that's the case, you have those top 7 stocks or top 10 stocks in the S&P become more than a third of the index, which is historically high because it's trapped investors in not really confusion, but just so much uncertainty that you got to go with the growth. That's why the Russell 2000 typically and the smaller cap and broader market have responded to rate cuts. But ultimately, we've got to get out of this zombie economy where is it alive, is it dead, you don't know. And it really, I think that is ahead of us, and it's what the unemployment rate is beginning to message.
Are you worried that unemployment is going to get higher to 5% in a swift manner? I mean, 4.3 is not too bad, especially if it's because of a growing labor market more than layoffs. But if the latter starts to come, it'll be difficult for the market to handle.
Well, Matt, as you know, I mean, we've been talking for a long time. And as we know, the unemployment rate, Goolsbee said it yesterday, the unemployment rate goes up on a rocket ship and down, I say it goes up on an elevator, down on an escalator. You know, the rates have to come down pretty hard because the unemployment rate doesn't go up slowly. That's what I meant. The unemployment rate goes up on an elevator and down on an escalator. Companies don't want to hire people unless they have to, unless they believe that you're losing out on potential revenue. But when the costs get up there and the revenue falls, you can't cut costs fast enough for the revenue shortfall. That's why if you look at company profit margins, and this all ties back to the employment picture, profit margins really collapse during a recession because you can't cut employee costs quickly enough. So when it happens quick. And the signs are there in the last few, not just the last one, but the last few employment reports that were trending toward that rocket ship in the unemployment rate. And ultimately, Matt, I think that's what you got to have to clear out this economic zombie-like environment
Tony,
that I identified.
you know, that saying about going up on an elevator and down on an escalator, I heard the same thing for equities yesterday as well. I'm curious how you handicap where the floor is to this market and how much more downside risk there really is.
I think the craziest thing, Denali, is people like me come on TV and say, and make a wild guess at that. This thing is obviously yesterday, you're driven by algorithms, you're driven by quants. The day-to-day stuff, I don't think isn't necessarily related just to the macro. It's where the stop levels are. It's where those, so you get these extreme moves. I mean, just look at Japan, down 12% and then up 10%.
Nuts.
That's telling you that there's something else at play on a day-to-day movement. So what I like to do is step back and say, okay, what direction is the employment picture going? It's worsening. What direction is consumption going? It's worsening. And those are the drivers, really, of the forward-looking economy. So then the question becomes, is it going to be a 2008 environment, or is it going to be like an S&L crisis in 1990? Remember, a recession happens when companies need access to capital, and there's no capital to provide from either the bank or private sources. I think it's the opposite today. The banks are in very good shape from a capital level. The private equity and private credit side are getting new money in every day. They're just unwilling to deploy that capital for growth until we remove the uncertainty about a forward-looking recession.
So if you have cash to put to work now, Tony, you know, there's over $6 trillion in money market funds earning a solid, 5%. Do you pull that out and make some purchases? Do you dollar cost average in? Do you buy some of these buffered ETFs that Gargi was just talking about? What do you do?
Well, so Matt, two things. Number one, I add into weakness in the broader market, not the S&P. I'm sorry, I am not able to. I'm not a research analyst for the top 7 companies or even the top 10, which now represent about a third of the S&P 500. So I would like to buy into a more equal-weighted market in the smaller cap market, but I think you need a little bit more weakness. In terms of the $6 trillion, I want to dispel the myth that somehow $6 trillion can come into the equity market. The vast majority of that money, Matt, is designated as working capital in corporate America. So if you went out and raised money over the last 2 years and you put those millions of dollars in a money market fund because you haven't deployed it yet as a company, that's your working capital. You're not going to put that in the S&P 500 or anywhere else in the market. So the idea that there's $6 trillion waiting to come in, I think is totally inappropriate.
Agree. Well, or rainy day funds. I mean, that's where families who do save are holding that cash, and they're obviously not going to go and buy stocks today trying to catch falling knives.
Certainly a lot of people out there thinking cash is the place to stay. Tony Dwyer, we thank you so very much. That is market strategist at Canaccord Genuity. Now, I want to say also Bloomberg confirming now that Vice President Kamala Harris has tapped Minnesota Governor Tim Walz as her running mate. We're going to have more on that in the next hour with Wendy Schiller of the Taubman Center at Brown University. Of course, certainly the story of the morning ahead of Kamala Harris's speech tonight. Now, coming up, we're going to talk more about earnings. Palantir shares surging after the data analysis company says it'll earn more money selling AI software. Ed Ludlow is going to join us from the West Coast with all the tech earnings news, including Tesla rivals Lucid and Rivian, both up this morning. Stick with us. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself.
I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is Bloomberg Open Interest. A quick check on the stock market here, of course, because you have the NASDAQ 100 really flat on the day, flipping into red territory, back and forth, really. The S&P 500 still keeping gains of about 0.3%. Interesting here to see those moves. Russell 2000 also slipping really out of the green here, but pretty much flat on the morning. We'll keep an eye on it as we go along, Matt.
All right, time now for top calls. Some of the analyst action in focus this morning. First up, Morgan Stanley is removing Amazon as a top pick. The bank citing increasing margin pressures and says the tech giant needs to demonstrate an ability to deliver growth and profitability. Next up, Piper Sandler is raising its rating on CrowdStrike to overweight, saying investors should build positions at current levels. The analyst says the cybersecurity company has been put in the penalty box, but the stock represents a compelling risk-reward going forward. And finally, Cantor Fitzgerald is upgrading Lucid to neutral on news of a $1.5 billion cash infusion. The struggling EV maker announcing today that it received, yesterday, that it received the funding from Saudi Arabia's Public Investment Fund. The lifeline comes as the car maker works to overcome production hurdles, and obviously with slowing EV demand, it's pretty difficult, Shanali. I'm looking forward to talking to the CEO, Peter Rawlinson, in the next hour.
And now Bloomberg Technology co-host Ed Ludlow joins us from San Francisco. And maybe we start just there because you are so deep into this electric vehicle story. You see this massive investment from a division of Saudi Arabia's Public Investment Fund. And you wonder, will it get Lucid to its goals when you look at how much competition and, frankly, the lack of exuberance there is this year around the EV sector?
Yeah, I mean, $1.5 billion seems like a lot. It's on the heels of a $1 billion injection in March. So they keep tapping Saudi for more money. But $1.5 billion, 50% of it's convertible, 50% is an unsecured loan. It's not a lot of money in the context that negative free cash flow is like $750 million a quarter still. They're only selling 2,000, 2,400 vehicles a quarter. And they've been doing that for a couple of years. They're not really making any progress on scaling. And yes, they're launching this new SUV, but 2 models at a premium price point in the market that Matt described. It's gonna take a lot more for them to sort of convince the market of the long term, I think.
Yeah, when we compare Lucid to Rivian, and Rivian has earnings out tonight, Right. How much do they lose per vehicle? Rivian's losing, what, $40,000 per vehicle? And Lucid, with those numbers, is losing a lot more.
Yeah, Lucid's losing a lot more, but Rivian's the same story, right? I think the estimate for Rivian's negative free cash flow is like 900 million. I guess the point of difference with Rivian is that they're operating at a different scale. 57,000 vehicles this year is the target for production. And they have a stated goal. So they're losing $39,000 per vehicle on a gross loss basis right now. They have a pledge to be gross profitable on each unit sold modestly in 4Q. And a big part of that story is retooling, changing parts, but also tax credits. So that's somewhere I'm going to be looking for in the earnings statement is tax credits, because they've listed it as a big factor of their pathway to profitability. But that's funny, isn't it? Relying on tax credits rather than actually selling vehicles profitably en masse kind of echoes the early days of Tesla's pursuit of profit.
Ed, I want to switch gears and talk about Uber a little bit here, because you are seeing a lift in shares this morning, and you're seeing them really coming in with better than expected results. How do you see Uber's kind of standing here in terms of worries about the consumer? They're really shaking them off.
Yeah. Well, at a macro level, if you put it in aggregate with DoorDash, you're getting a similar story, that the demand side of that economy is intact. So gross bookings on the platform, which is basically everything that transacts through it, minus tips, up 19% year on year. The bottom line, Uber's done very well. 50% of the transactions done on the delivery side were Uber One paid membership. So something's working in the business model, but it is very positive that they're able to sort of hold up this demand, particularly on the sort of more premium side of the platform. And the street really likes it, whether you use adjusted earnings or otherwise. It's a good story.
All right, Ed, thanks so much for joining us. Bloomberg Technology co-host Ed Ludlow has a lot to talk about on his program, so definitely join him with Caroline Hyde at 11. And don't miss our conversation with the CEO of Lucid in the next hour. Then tomorrow, we're going to hear from Rivian CEO RJ Scaringe, following his earnings report right here on Bloomberg Open Interest with Ed Ludlow, our EV reporter. Coming up, the plunge in global shares stunned even seasoned market observers. We take a look at the $6.4 trillion sell-off next. That and more in our Wall Street Beat. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We think that the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. So we are not done by any stretch. Some of the technical studies we've done suggest that once you get very large, sharp moves in short periods of time, like we've had with the yen, the technical damage that it inflicts on portfolios is not easily undone.
And it's time now for the Wall Street Beat, because we're looking at the $6.4 trillion global wipeout and how some fear the great unwind has just begun. It's today's big take, and joining us now is Bloomberg's Bailey Lipschultz, who's one of the authors on this story, of course, one of the most read. And this is the big worry, isn't it? That we saw this sell-off yesterday, we saw volatility blow out, and really there's more to come.
Well, that's the big uncertainty and the big unknown, Sonali, is that no one knows if this is the, as we write, if this is the end of a 3-week pull down that really accelerated over the last 3 days, or if it's a sign of things to come. And when you look at volatility spiking like it did, and you look at the kind of rotation away from stocks that we've been seeing, it's no longer selling big tech to buy utilities. Everything was down sharply yesterday. The big question is, how does the Japanese yen play into that? How does the kind of lacing of all of these markets, whether it's bonds, stocks, or even crypto, how does that play out?
And perhaps a market that was more levered than met the eye.
Yeah, I think it's important to kind of explain the carry trade, at least in basic terms, for viewers who aren't, immersed in, like Sonali obviously talks about it every day. But basically, you have a generation of traders who are borrowing yen, selling them for dollars, and then putting the dollars into more profitable trades here, right? They haven't really seen this kind of snapback very often in terms of the yen going from, 162 to 140 in 2 weeks.
No, precisely. And you see that July 3rd, we were at 161, almost 162 on the dollar yen. And now, as you mentioned, it is 144, going back towards that 140 level that we saw coming into the year. So as you mentioned, if you're borrowing yen because the interest is so low and the cost is so cheap to then deploy it, whether that's into bonds, whether that's into NVIDIA, the Mag 7 names, when those trades unwind, you're forced to sell to then bring that back to the
right. They owe the 161, exactly. And now their dollar only buys 140, exactly. So they need to spend more to get that money back.
And this goes back to, and I've been covering markets for a number of years, and you have conversations, whether you're an industry specialist or a macro investor, you wind and unwind trades. So we're seeing that unwinding because people have piled into similar trades.
Now, that's a massive unwind with a carry trade alone. There's another wonky dynamic here, and that is all the people who are having to sell volatility into this market. And you saw that panic level of 65 yesterday. You're now back down to about 31. Still, 31 is relatively elevated to where we've been. Bailey, you cover the capital markets so closely. There was an IPO comeback. There was a bond market comeback in terms of issuance. A VIX at 30. Does that ruin all of that hope?
Well, the one thing when you look at, especially with new issuance, August is so quiet historically. So we happen to be in a month where people aren't actually going to raise capital.
Pain could have been worse.
Exactly. If this happened post Labor Day, when we're penciling in a lot of these bigger deals, the last real window when I talk to capital markets bankers, that's when the pain could be kind of more drawn out and more kind of dire for would-be issuers. Whereas, again, we're seeing the turnaround Tuesday not really play out, but the big question is what happens in the coming days and weeks, just given, for the most part, big tech earnings are behind us, and a lot of those seasonal factors are going to weigh. Typically, we see August and September being weak.
A lot of people are lucky this happened in August. They're sitting at the Paris Olympics watching their Bloomberg terminals on their phone.
I think you're lucky already if you're sitting at the Paris Olympics. Bailey, thanks very much. Bloomberg's Bailey Lipschultz there talking to us about the unwinding of the carry trade. Coming up in the next hour, Lucid CEO Peter Rawlinson is going to join us at 10:30 a.m. Eastern. We'll talk to him about his earnings and the cash injection they got from Saudi Arabia. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you were the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. This is a Bloomberg Intelligence radio program for the next 2 hours. Alex Steele and Paul Sweeney, we are with you. We're also streaming live on YouTube, so check us out there on youtube.com. Search Bloomberg Podcast. Coming up, Gina Martin Adams, Bloomberg Intelligence. She is the U.S. equity market strategist. What is she making in this market? It's been a crazy few days. Ira Jersey is going to join us. He is the rate strategist for Bloomberg Intelligence. What's his Federal Reserve going to do? And isn't there a meeting, I think, in Jackson Hole somewhere? I'm not sure that's coming up. Margie Patel, Senior Portfolio Manager, Allspring Global Investments, is going to join us to give us her market thoughts here on what has been a very tumultuous last several days in the marketplace. We do have green on the screen right now. Let's kick everything off. We'll check in with Lisa Mateo with Bloomberg Business Flash.
You got it. Market Drivers brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, markets battling back after this 3-day sell-off. Traders looking for bargains. A Goldman Sachs analysis of 4 decades of data, well, it shows buying the S&P 500 after a 5% drop is usually profitable. But Citi strategists, well, they recommend waiting before buying the dip. We have the NASDAQ now up about 0.5%, 80 points at 16,282. The S&P 500 up 0.9%, 47 points, 5,233. The Dow up 0.8%, 327 points at 39,036. Tech stocks really took a hit yesterday, especially NVIDIA. I want to check in with a few of them. We have NVIDIA up about 2.5%, more than 2.5%. Tesla down 0.5%. Microsoft up about 1.5%, but Amazon down 0.5%, and Apple down more than 2.5%. The bond market, we have the 2-year yield, 3.94%. That's up 2 basis points. The yield on the 10-year, 3.83%, and that's up 4 basis points. It was a global sell-off yesterday, so I want to take a little wider look. We'll look at the stock 600 right now, up about 0.1%. The Nikkei, quite a difference from yesterday, up 10%. And as far as currencies, the Japanese yen down about 0.1% at 144.44 against the dollar. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa, Mateo. So I gotta say, after the last 2 trading days, this is like a letdown.
Right.
Like, I'm like, oh, yeah, stocks are up. The Dow's at 350 points. I was mentioning this yesterday when I was on the close, though. There's been so many reports of so much systemic funds, so like vol trading funds, CTAs, that have much more to sell, and that
Right.
gamma hedging could also be set up to sell too. I just don't buy this rally. I mean, I think I'm going to talk about dead cats.
Okay.
I'm going to
All
talk
right.
about some dead cats
Very good.
bouncing over the next couple hours. Norma Linda joins us in studio with some stocks to watch. All right, you're looking at individual movers, not the dead cats bouncing, but Lucid really delivering.
It is here. We are seeing shares of Lucid jumping as much as 13%, now pairing a bit. But this is after a large cash infusion of as much as $1.5 billion from an affiliate of Saudi Arabia's public investment fund. We are getting Cantor Fitzgerald upgrading the stock to neutral from sell coming off of this news. But one thing to note that while $1.5 billion seems like a lot, this is on the heels of a $1 billion injection that we did see in March. 50% is convertible, 50% is an unsecured loan. But in reality, this is really not a lot of money, especially with the company having a negative free cash flow for some $750 million a quarter still. It's only really... Yes,
okay.
So pretty strong and very intense there. So it's not really making progress on its scaling as it's really trying to scale the company, and it's only selling not too crazy amount of cars here. So the stock is still down about 29% for the year through yesterday's close. And of course, we do hear from Rivian tonight with those earnings coming out.
I'm just looking at the FA function for Lucid and free cash flow forecast from the street for 2024, negative 3.5 billion, a little bit better next year to negative 3 billion, but still it seems like it's a ways away from free cash flow positive.
Yeah.
Right,
And
so
talking
important to note.
Talking about Rivian too, didn't Volkswagen make an investment and cash infusion into Rivian also?
Right.
So clearly, like, the startups that have the technology to do the stuff still though need the cash. Speaking of Uber.
Yes, let's take a look at Uber. We're seeing shares up for the most since February, up as much as 7.3%. Now, this is after better than expected orders. We're still seeing demand for rideshare and delivery services. It saw gross bookings that grew 19% last quarter, citing that there was particularly strength in Latin America and the Asia Pacific. Of course, you know, all eyes, we are keeping an eye on Lyft, which will be reporting results before the opening bell tomorrow, but this is a strong report from Uber.
I don't know. I guess I'm not sure if I've asked you guys before. Do you comparison shop Uber versus Lyft, or do you just go right to
No,
one?
this is a Pulse special.
I do.
You do?
I do. I open both apps, and
Yes.
I also open, thirdly, the Curb app, which is great for New York City, and I see which one's the cheapest, and I click on that one.
See, that's why I like her.
Okay, I'm super behind on this, apparently.
Yes.
But
You and Matt Miller just go right to Uber.
Wow.
Brand loyalty.
But this
or laziness, I'm not sure which.
It's laziness. But is this a good thing for Lyft or for Uber? Because Lyft is undercutting people on prices.
Right, good thing for me in my pockets.
Yeah, all right, no, fair enough. But if Lyft is sort of undercutting their prices in order to get business, is there enough business? Are there enough Pauls and Nors around to make up for the fares?
Yeah, I'm not sure. It
Hopefully
look
we're
like
not
the
one of
stock's
you.
like way underperforming Uber. It's a fraction of the valuation. So anyway, what else you got?
I'm also looking at Lumen Technologies. We're seeing shares climbing as much as 62%. Now, that's the most since July 30th, but that percentage gain that we did see last Tuesday on July 30th was the biggest one-day advance on record. So I'm closely watching to see whether it'll top that as well. But this is coming after the company said that its AI demand has driven $5 billion of new business. And additionally, it's in talks for another $7 billion in potential sales. I looked at Citigroup, which has upgraded the stock from neutral, or to neutral rather, from sell.
All right, thank you, Noor. We appreciate Norma Linda joining us from Bloomberg News. You'll come back at the top of the next hour to update us on what equity markets are doing. All right, Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, joins us in studio. Gina, I know you're going to tell me that I'm wrong, but I was talking about dead cats bouncing. I'm really skeptical as to this turnaround Tuesday actually having legs when I just can't imagine all the stuff we've talked about over the last 48 hours magically disappeared. Am I wrong?
First of all, Alex, I don't know why you assume I'm going to tell you you're wrong. You're not wrong. Honestly, I think it's just too early to know. I think really, if you go back to how all of this really started, it started with the Central Bank of Japan raising rates, and then it kind of got blown into bigger and bigger stories as the week went on last week. And over the weekend, the crash in Japan just terrified everyone. So I think some stabilization there has helped the U.S. equity market a lot coming into today. We also got oversold. We had a natural need for a bounce with the VIX extreme as well as the oversold level. So the technicals were set up very well. I really think what we need to watch now is what happens with the carry trade, what happens with the unwind, what happens with Japanese stocks overnight, because that will largely frame the case. It's very rare, honestly, that you see Asia lead U.S. It usually is a U.S. lead. So we're sitting in a bit of an awkward position right now. There have been other factors certainly weighing on stocks. What is the Fed going to do? Are they moving fast enough? Is the tech sector sort of losing its panache as a leader? And so there's a lot of other things that we need to consider in the U.S. But the biggest, boldest thing I think to watch right now is really what happens with Japan and this carry trade unwind, and does it create forced liquidity selling across the spectrum of asset classes.
Was there panic selling yesterday, particularly in the morning, did you think?
I thought so in the morning. I mean, you pretty rarely see the VIX spike above 60 without there being some panic.
The day Tom Keene was not here, the king of the VIX.
I know, he missed out. He must be really kicking himself. But it was, it was definitely very panicky over Sunday night. And again, that was really related to Asia and what happened with the Japanese assets just crashing over the course of the weekend. So it calmed throughout the day, which is a pretty good sign for the U.S. being able to come in and bring some stability. The ISM services number obviously helped a little bit with sentiment. The earnings numbers that we have gotten over the course of the last few days have been fairly stable. So from a fundamental perspective, I think that we're in relatively solid ground here in the U.S., but there's a lot of uncertainty with respect to the financial market stability kind of coming out of this first in 17-year move out of the Japanese central bank, which is not a small thing.
So I just want to clarify what dead cat bounce is, because Samantha, one of our producers, mentioned it. So basically, it is a rally in a downtrend. So stocks bounce, but the trend is still lower. And you talk about dead cats because cats always land on their feet. It's something about the cats. I don't know. Anyway, they call it dead cat bounce. When do you think we're going to know, or how do we know if the carry trade unwind is over? Because the funny thing is, if the Fed did like an emergency rate cut, that would make the carry trade worse, because then the yen would rally even more.
Yep, I totally agree with you. And this is where some of the popular sentiment has gotten it wrong, is this is not necessarily just about the U.S. and the U.S. specifically. And is the U.S. data weak enough to really justify a Fed cut? The consequences of a Fed cut right now are pretty high outside of the U.S. and might actually exacerbate the problem. So the Fed sitting on hold, I do believe, is the right thing to do. It seems to be where they're headed. And these calls for the need for a Fed cut are probably somewhat misplaced in my mind. How will we know? You won't know in a day. You probably won't know in a week. You'll only know in hindsight that it's over. What I will say is there are some key indicators that would suggest we actually, though we've had a 10% correction in stocks, we haven't even really tested the longer-term bull uptrend. And so as long as stocks are still trading above their 200-day moving average, you're technically still in an uptrend. 70% of stocks in the S&P 500 are still trading above their own individual 200-day moving average. So we're still in the longer-term bull market. We're just in some kind of corrective phase in that bull market. When will it end? Well, it'll end when the last seller has left the building, and we finally get some buyers coming into the market. You finally get some leadership emerging on the market that is not defensive in nature. Low vol stocks start to underperform high vol stocks. You get a little bit of risk on in small caps. Then you'll know that things are definitely over, the risk has cleared. But I would watch Japan very, very carefully. You need to see some stability there first in this instance.
All right, great. Gina Martin-Adams, thank you so much. We appreciate it. As always, Gina Martin-Adams, she is the U.S. equity strategist that rely upon. She's over there at Bloomberg Intelligence. I have no idea who she reports to anymore. It's just a whole different thing going on there. Let's check in with Ira Jersey. He is a rates strategist. Yes, that is a job. You can build a career being a rates strategist on Wall Street. Ira is proof perfect of that. Ira, what's your Federal Reserve going to do? It's not going to come in and do an emergency rate cut, is it?
Yeah, there's been so much talk about that the last 24 hours. It's actually kind of making me ill. That's why I'm working from home today. But the Fed's not going to come in just because the stock market's down 5, 6, 7%, right? The Federal Reserve is going to cut rates because they think that the economy is faltering and because the unemployment rate's going up and because they're worried that the economy will fall further. Now, oftentimes that happens when the equity market is down quite a lot because that's often a signal that we're going into a recession. We're going to have an earnings slowdown. We're going to have profitability is going to be weak. We're going to have weak retail sales, all of those kind of things. So, it's not only one thing. The Fed would step in and try to provide some liquidity to markets if they thought the market wasn't functioning. But I think in what you saw in a lot of the price action yesterday, the markets were functioning, right? They just the price going down doesn't mean the market's not functioning. That's two completely different things. The bond market, I think, is rethinking the whole idea that the Fed is going to have an intermediate cut, not the Fed's going to cut even further. But just look at two-year yields. Two-year yields just in the last couple of weeks are down 50 basis points. And that's effectively saying the market saying that we think the Fed's going to cut more than we thought a couple of weeks ago. And I think that that's reasonable. And that's been in our forecast for basically the whole year because the market's basically pricing out all of the tail risk that we're going to have a very soft landing where the Fed might only need to ease 50 or 75 basis points. And I think that that's kind of what you're seeing in a lot of the price action. Volatility aside, I mean, the longer term kind of 2-3 week price action here.
Ira, do we know what positioning looks like yet after sort of that wash? I don't want to say washout because it was a lot of buying, but that sort of cratering in yields?
Well, there was certainly a lot of short covering in that, and we talked about that yesterday, Alex. One of the it's not who's positioned which way. You look at something like the J.P. Morgan survey of Treasury sentiment, and you see that their active investor sentiment index is now negative, suggesting that active investors are short. But then you look at their overall index, so that just everybody, and they're continuing to be long, and that's a pretty unusual situation actually for that particular indicator. A lot of investors that we've spoken to are kind of wait and see. They're sitting on their hands. Those who are long are obviously pretty happy and probably going to remain in those positions. And those short are certainly getting nervous, right? So I think that's showing you that when you get moves like we had yesterday, firstly, it was on the back of the equity market swooning, right? And Gina just talked about why she thought that was. I'm a little bit more skeptical that it's all about the carry trade. But the idea that when you have equities down 4%, you're going to go have a flight to quality trade, and that's what we saw. And that will scare shorts into covering those shorts, and that just makes these moves more dramatic, and why you have these bounce backs that can be pretty significant. But we are in a lot of new levels, and I think that at this point, the market, the Treasury market anyway, is going to be looking for new levels to sit in from now until the September meeting when the Federal Reserve is likely to cut interest rates, and then the future guidance of that, right? We get new dots, we get their new summary of economic projections, plus obviously Jay Powell might say, hey, this is just the start of a string of cuts, or he might say, we're not really sure how far we're going to have to go here, and that can wind up creating more volatility in the Treasury market as well.
All right, I want to get to the important stuff here. Today, semifinals, Olympics, soccer, men's soccer. I'm sorry, where are we in the soccer for the men's in the Olympics, Ira?
The U.S. men bowed out. We lost 4-0 to a very good Morocco team in the quarterfinals. So Morocco's looking very good. I would not be surprised at all if they wound up winning this tournament. So
I see
remember,
yesterday,
the Olympic tournament is under 23s. So
I guess yesterday Spain beat Morocco 2-1. So now we got in the finals for the Olympics, France versus Spain. That seems like how it should be, right? Aren't they kind of two of the best? around?
Yeah, it's hard to know with the under 23 tournaments like this because they're not the marquee names, so it's a little bit more difficult. I'm a little bit more interested to see how the U.S. women do because the U.S. women are ranked 5th in the world, and it's an interesting tournament. And Emma Hayes, the new manager, really has not rotated many of the players. So will the U.S. women have enough fitness in order to go further? We play Germany again, which is a team that we beat pretty soundly in the group stage. So we play them again in the semifinals, and then once we get to the finals, obviously we'll be playing for a medal. We're effectively playing for a medal this game, right? Because presumably, we'll be in the bronze medal match at the worst, but we'd like to obviously be in the finals.
I should point out, noon is when the soccer tournament for the semifinals kicks off. So I know nothing about sports, but I'm super into the Olympics. So this is like the one time in my life for 14 days where I can say things that like Paul doesn't know or like Scarlet Fu isn't aware of. So I'll take that picture.
Very good. U.S. versus Germany, 12 noon for women's soccer, and then 3 p.m. Brazil versus Spain. So we got some great women's soccer at the Olympics. So Ira Jersey, he is our rate strategist, but he's also our soccer guru. We go to him when we need to figure out what's going on with all these crazy tournaments all around the world. I can't keep track, but Ira does. He also, owns and part owner of a minor league soccer team, Real Central, New Jersey. It is a thing, and he's all over it. So he's our soccer go-to. We're gonna have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got green across the screen. Markets bouncing back after that sell-off that erased $6.5 trillion from global equity markets over the past few weeks. We have the NASDAQ up more than 1%, the S&P 500 up more than 1%, the Dow up 0.9%. We take it to the two-year yield at 3.94%. That's up 2 basis points. The yield on the 10-year, 3.84%, and that's up 4 basis points. Bitcoin, got to give it a moment. Yeah, yesterday we talked about it. It was down like 16%. Right now, Bitcoin up 3% at 56,393. Crypto-linked currencies, companies also took a hit. Still, Coinbase Global, it was down double digits yesterday. Right now, up 1%. We have MicroStrategy up 2%. More economic data out today. U.S. exports, they're up. Yeah, foreign demand, American goods and services, it rose by the most in 5 months in June, and that caused a trade deficit to narrow for the first time in 3 months. The export gain was led by commercial aircraft, natural gas, autos. U.S. imports also rose in June, though at a little bit of a slower pace. Tomorrow, there's more data on tap. We have a report on consumer credit. Thursday, we're on to initial jobless claims. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. You can also check us on YouTube. Don't miss us there. So to get a big perspective on the market, if you're a long-term investor, what do you do over the last, 48 hours in the markets? This is when I get like my financial guy sending me the email of like, just so you know, this is what happened. This is what we can expect. So how do you do that? Well, Margie Patel is Senior Portfolio Manager at All Springs Global Investments, and she joins us now on Zoom from Boston, Massachusetts. Margie, what do you make of the last 24 hours? Or 48? Is this a regime shift, a real paradigm shift, or is it still stay on message, stay on trend?
I think it's still the same things. Large cap stocks are still going to be the place to be through the rest of the year. I think what happened is after a few quarters where the Mag 7 or the dozen largest stocks reported better than expected earnings, that gave the market a real boost in confidence. And this time we had really sort of mixed results where some of the companies reported results that were frankly disappointing. And that took away market confidence at a time when you had stock prices at their peak. You have concern about what the Fed is going to do, data that says the economy is slowing down. So I think that's what we had is just a real short-term step down, S&P down 9%-ish, NASDAQ down 12, 13-ish, and really just a short-term correction that's almost played out. We probably have a little bit more, and I think we'll go up for the rest of the year.
So, Margie, to the extent that we do go up for the rest of the year, is tech going to continue to lead this market, or have we seen some kind of rotation that is of note?
I don't think we'll see much of a rotation because when you look at the economic growth level, what you think the economy will grow at for the next few quarters, I think it'll be rather low, 1%, 1.5%, something like that. So that says you still have to stick with those sectors that have above average growth, which again would be tech in particular, some other sectors, but primarily tech, especially when a lot of these stocks have had such a big correction. They're really priced more or less in the middle of their value range. So if the earnings go up, we think that these stocks can go up too.
So I guess this is a buy the dip kind of setup for you, Margie?
Yeah, sort of, especially some of those names have had big corrections. But it's interesting although people talk about the correction, when you look at the indexes, Standard & Poor's, NASDAQ, Dow Jones, those indexes are all still up very attractively year to date, mid to high single digit for a little over halfway through the year. So that says that's really on track to be an above average long-term rate of return for stocks, certainly not a disaster. And even if you look at something like NVIDIA, which I think is down 40% from its peak, it's still up 100% year to date. So it isn't as if we're having a real unwinding, 2000 type internet bubble meltdown, a permanent impairment. I think this is just a short-term correction, typical in summer, and then we'll see the market move ahead in the rest of the year.
Hey, Margie, how about the fixed income market? I'm looking here at my INGO function, the Bloomberg Index browser. It says across fixed income, I'm seeing 3-4% type total returns. That's about as good as I've seen in a long time. What do you think about opportunities in the fixed income space?
Yes, it is, because actually many sectors of the fixed income market have been negative. As rates have gone up, prices are sensitive to that and they've gone down. And really high yield has been about the best performing sector. But it's still, you're looking at 3-4% year-to-date returns, really pretty modest. But I think what you're seeing, though, is the yield spreads still, to me, are telegraphing that the economy is okay, the fixed income market is okay. You've had spreads widen out, say 40, 50 basis points for most high yield bonds. However, most of that spread widening has been because treasury yields have dropped so much from, say, their peak yield in April, where the 10-year was around a 460 to, say, a 380 now. That's an 80 basis point correction, and high yield has not caught up to that. So I think it's not showing any distress in high yield, that spreads have widened out a little bit. I think it's just this huge move in treasuries has changed that relationship, but the fundamentals are still there, still pretty good for fixed income.
Yeah, when I looked at the spreads yesterday, I was like, oh my God, they're still so low. Like, I understand they went up, but so I guess my question, Margie, is what would a regime change or regime shift really look like then?
Well, frankly, I really can't see it. I think that we had a kind of a little play in value stocks. It sort of petered out. We've had a play in small cap stocks, which looks as if it's petered out. And so I think we're still back to the same themes as where do you want to invest in a slow growth economy, which is what I think we're really looking at over the next, certainly in the next few quarters, no matter what the Fed does. We're hoping, of course, that the Fed will see the light like the market and start to cut rates. But I think the economy is just going to chug along at modest 1% type growth. So where do you invest for that? You look at companies that are in the highest sectors, again, tech, certain parts of industrials, certain very few selected in healthcare, maybe some materials. But in other words, it's still a very selective market. So we don't look for broadening out either, much as we'd all like to see it, but we just don't see that happening.
Margie, for better or worse, this is an election year, Margie. How does that factor into your calculus, if at all?
Well, historically, and there aren't many historic things you can rely on, it always seems that in an election year, no matter who gets elected, that we have a pretty good rally after the election into the end of the year. So I'm thinking we waffle around here because of earnings and uncertainty of the election. And no matter who is elected, we have certainty. And I would expect the market to have a strong finish in any case. And by that, I mean a modest finish. I'm not looking for say, a doubling another 8 to 10% over the rest of the year, but, 3-5%, something like that, to finish off the year.
Margie, do you still, well, you mentioned slow growth, but we do have an election where it looks like both parties are going to be spending boatloads of money. The hyperscalers are spending boatloads of money. When do you think that really filters through and sort of helps stabilize that growth?
Well, it's true you have a lot of capital investment going into certain sectors. Again, mainly the technology sector is the biggest spender, the biggest beneficiary. And so we think that trend is going to stay. And as far as fiscal spending, we already sort of blew the doors off for the last few years, either with COVID expenditures or inflation or infrastructure expenditures. So really, it's really difficult to see another big blast of fiscal expenditures helping to push up the market of the economy short term.
All right, Margie Patel, thank you so much. We appreciate that. As always, appreciate the perspective. Margie Patel, Senior Portfolio Manager, Allspring Global Investments, joining us from Boston, Mass. Via Zoom. Deadpool, do I see it this weekend?
Yes! Wait, but you have to see the first two first. I mean, you don't have to.
I've seen the first one. I haven't seen the second one.
Okay. The second one's better, I think.
Okay. But see, John Tucker didn't give it a rave review.
No. But, I mean, I don't think that it was meant for John Tucker. I don't know. Do you like humor?
Yes.
Okay. Do you like...
Well, I like that. Who's the Deadpool dude?
Ryan Reynolds?
Yeah, he's very good.
Do you like violence or are interested in funny violence?
Yeah, maybe funny violence.
Funny violence is definitely funny violence.
But this is rated R, though, right? So you did not take your daughter.
Definitely didn't take my daughter.
Okay.
But she knows that I love Deadpool. But I do think, honestly, I think you'd really appreciate it because there's so many nice Fox-Disney merger nuances.
Oh, that's always good for media insight.
So I kind of feel like you would appreciate that even if you didn't love it.
Okay.
Don't you think he'd appreciate that, John Tucker?
No, I don't think so.
What? I think he would.
I mean, it's getting huge box office, right?
Yeah, what does anybody care about reviews?
The reviews were pretty good.
Yeah.
Did you read any, or is it just like, does anyone care about John Tucker's review?
There's only one review that matters.
It's Rotten Tomatoes is kind of where the kids go now.
Yeah, I mean, there were some, it clearly was not as good as the first and second, and that was noted in certain reviews, but, they appreciated the movie, they appreciated the charm. I mean, also, it's pretty formulaic, right? Like, he has a crass mouth, and he curses and kills people, and it's funny.
$782.6 million U.S. box office so far globally.
Alex thinks the killing is funny. Okay.
The way they do it is very funny. Come on now.
It's a
Got
comic
you
book.
pegged.
It's comic book
Okay, so why don't you see it? It's going to rain this weekend, right? Because Hurricane Debbie is coming our way, right?
Yeah.
So if it rains, you do that. We can talk about it Monday.
Is that what's that? Hurricane Debbie's going to come up?
Well, I mean, I feel like we're going to get
It's
some blow-off
possible
storms, right?
now a tropical storm, but still big rainmakers.
Yeah.
So it's headed up
It's
to
coming.
the tri-state
Yeah, I've seen some
region in New
amazing
York.
rain down there and crazy down there for our friends in Florida and Georgia and so on. So.
All right, well, coming up, we won't talk about Deadpool, but we will talk about tech. Jen Rhee, Bloomberg Intelligence Senior Litigation Analyst, is going to join us. So Google is accused now of monopolizing search through illegal deals. We're going to break down what that means for Apple, actually. And here is, well, as you know, John Tucker, and he's joining us for world and national news. John.
All right. Vice President Kamala Harris has picked Minnesota Governor Tim Walz as a running mate, looking to strengthen the Democratic ticket in Midwestern states. She's going to introduce Walz at a rally this evening in Philadelphia. Brown University political science professor Wendy Schiller says Walz is the safe choice.
Kamala Harris chose the most, quote-unquote, neutral within the Democratic Party. In other words, nobody who had any baggage with key constituencies like the unions, like people who are very passionate about Israel, Gaza. I think that and school choice, particularly the teachers' unions, in terms of vouchers, like Josh Shapiro. So she went with the person who will do no harm.
Florida Governor Ron DeSantis calls it the most left-wing ticket in American history. The deluge from Debbie has been destructive. The Category 1 hurricane downgraded to tropical storm. Its meandering movement as it travels northward has made for serious problems in low-lying cities. And Bloomberg meteorologist Rob Carolyn is tracking the storm.
Tropical storm Debbie, now located about 50 miles southwest of Savannah, Georgia. It is moving off to the northeast at about 7 miles an hour. Top winds in Debbie now 45 miles an hour. Again, the big threat with Debbie is going to be flash flooding across eastern Georgia, parts of the Carolinas. Over the next several days, Debbie will be moving back out into the Atlantic later this morning and could regain some strength. But again, the big problem with the system is because it's stalled off the coast of the Carolinas and Georgia the next few days, very heavy rain will continue. I'm Rob Carolyn, Bloomberg Radio.
Hezbollah and Israeli forces exchanged fire today. Several projectiles penetrated Israeli airspace from Lebanon. Meantime, the U.S. and its allies working to head off a wider Mideast regional war following the killing of a top Hamas leader in Tehran. Global news, 24 hours a day, whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg.